Hello, all my dear students. I hope you all are doing good. So today we are going to start with our fifth part of CA Final Direct Tax Revision, full English, relevant for only November 2022 exams. Okay. So today we are going to start with the discussion of capital gains and other related topics like IFOS, taxation of dividend, taxation of gift, so on and so forth. Okay. So capital gains. Let us start with the discussion of capital gains. The first thing which we need to understand in the chapter of capital gains is the charging section of capital gains, which talks about the general chargeability. There are two types of charging section under the head capital gains. One is general charge, another is special charge. Today we are going to first of all talk about the general charge. General charging section, which is covered in section 45 subsection 1, which says that there has to be a profits and gains from transfer of a capital asset, and that gains will be chargeable in the previous year in which the transfer took place. In whichever year the transfer took place, the capital gains will be chargeable in that particular previous year. Okay. So we need to understand the meaning of these terms. What do you mean by profits and gains? What do you mean by transfer? What do you mean by capital asset? And what do you mean by shall be chargeable to tax in the previous year in which the transfer took place? So the first thing which we are trying to understand over here is what is capital asset. And therefore the term capital asset is defined in section 2 clause 14 in two parts. It means something and it does not include something. What does it mean? First of all, it means property of any kind held by an assessee, whether connected to business or profession or not, whether personal property, whether business property, all the property which is held by an assessee is a capital asset. Second, if any securities which are held by foreign institutional investors, if a security is held by FIIs, then they will always be capital asset, irrespective of the period of holding. Even if they are holding a security for 1 day or 1 hour or 1 minute and then they are selling it after 1 minute, then also it will always be capital assets in the hands of what? In the hands of foreign institutional investor. Third one, if there is any ULIP, not the normal insurance policy, this is an amendment made by Finance Act 2022. If there is any ULIP to which the fourth and the fifth proviso of 1010D does not apply, for that we need to understand what is 1010D and its fourth and fifth proviso. We will be looking at that at the later part of this particular lecture. Don't worry. But as of now, I am just saying it for the sake of saying it. If there is any ULIP on which there is no, fourth proviso and fifth proviso of 1010D is not applicable, then that ULIP will also be a capital asset. And if you transfer that ULIP, that will be subject to tax. Okay. Now, what does capital asset does not include? It does not include stock in trade, because stock in trade is covered in business and profession. It does not include personal and movable things. Something which is personal plus movable is not a capital asset. Something which is personal plus movable is not a capital asset. But however, these things are always capital asset. Jewelry is always capital asset. Archaeological collection, drawing, painting, sculptures or any other work of art. These assets are always considered as what? Always considered as capital asset. Do not forget this. Okay. Then rural agricultural land in India. There has to be a land which is agricultural land in India, which is rural area and it is in India. What do you mean by rural area? A land which is located at a place where population is less than 10,000. If the population of that area is less than 10,000, that area will be called as rural area. Otherwise, it will be called as urban area. So if the population is more than 10,000, but it is up to 1 lakh, then it is urban, and the area adjacent to that up to 2 kilometers will also be called as urban. If the population of the area is more than 1 lakh but up to 10 lakh, then that area is urban, and the area adjacent to that up to 6 kilometers will also be called as urban. If the population of that area is more than 10 lakh, then that area is urban, and the population adjacent to that area up to 8 kilometers will also be urban. Okay, so this is the 3 slabs which the government has given. Next, certain gold bonds are always excluded from the definition of what? From the definition of capital asset. And last but not least, deposit certificate under gold monetization scheme. So if you purchase a certificate under gold monetization scheme and if you transfer that certificate, if there is any gain, it is not subject to capital gains. Further, if you receive any interest from that deposit certificate which is under gold monetization scheme, that interest is also subject to no tax because it is exempt under section 1015. Now there are certain small issues. If I sell silver utensils, will that be considered as a personal asset and movable asset and eventually not subject to tax? And the answer is yes. If you sell silver utensil which is for personal purpose, it will not be subject to tax. What about gold utensils? Gold utensils are not considered as personal effect. So if you sell a gold utensil, you will be subject to tax. Okay. Then if you buy some gold bars, sovereign bars, etc. for puja, for the purpose of Diwali puja, Lakshmi puja, etc., whether if I sell that, whether that will be subject to tax? The answer is yes. You will be subject to tax if you sell some gold bar, some murti of Bhagwan, etc., some souvenir of Bhagwan, of God, etc. If you sell that, you will be subject to tax. Okay. Next, profits and gains are subject to tax over here. And the gain over here is supposed to be real gain, and real gain. Notional gain is not covered here. Anticipated gain is not covered here. What is covered is only real gain and real gain and real gain. Real gain means what? The sale consideration has to be real. If the government wishes to tax a fictional gain, then the government has to make separate charging section for that, like section 45(2), where the government has taken the sale consideration as FMV on the date of conversion. So in that case, the capital gains becomes what? Fictional and not actual. Okay. Now coming to the definition of transfer, because the capital asset has to be transferred. So what do we mean by the term transfer? The definition of transfer is defined in an inclusive manner. Transfer includes sale, transfer include exchange, transfer include relinquishment of any asset, extinguishment of any rights, compulsory acquisition. If there is any compulsory acquisition made by any government, then that is also a transfer. Transfer includes conversion of a capital asset into stock in trade. If you convert a capital asset into stock in trade in the eyes of the law, that is also a transfer. Then in case of immovable property, the moment you give the possession of the property, that is called as transfer. In case of immovable property for land and building, the moment you give the possession to the other person, it becomes transfer. Then in case of immovable property, the moment you transfer the enjoyment of the property, it becomes transfer. And last but not least, maturity or redemption of zero coupon bond is also a transfer. Okay. Then whether exchange amounts to transfer, the answer is yes. This was held by Supreme Court in the case of Orient Trading Company Limited, where what the assessee did, assessee gave the shares of one company and took the shares of another company from another person. So what is assessee doing? Assessee is transferring shares and in exchange not taking the money but taking the shares. So that is also subject to what? That is also subject to capital gains. Now that depends upon how you hold the shares. If you hold the shares like a capital asset, then you will be charged with capital gains. If you hold the assets like a stock in trade, then you will be charged with what? Business and profession, as it is mentioned over here. Now suppose next one. Suppose I bought a land around 15 years back, and just few days back I constructed a building on that. 15 years back I bought a land, few days back I constructed a building, and then I sold the entire superstructure. Then how will the capital gains be computed? Because land is long term, building is short term. So how will the capital gains computed? Then the law says that you have to bifurcate the sale consideration between land and building will be subject to short term capital gains and land will be subject to what? Long term capital gains. Is everyone clear with this? Now let's go ahead with the next part, and that is computation. The computation of capital gains is given under two sections. One is section 48 and one is section 50. What is section 48? Section 48 talks about computation in case of capital gains other than block. Those capital assets which does not form part of block of assets will be covered under 48, and the capital asset which form part of block of asset will be covered under section 50. I hope this classification is clear to everyone. Now this is a very simple way of computing capital gains. First, full value of consideration, then expenses on transfer, then acquisition, cost of improvement, and there is one new thing which has been added by Finance Act 2021. We will be talking about that in some time later. Today only, in some time later, we'll be talking about this. This is the final reduction which has to be made over here, which was not made till last year, but from this year onwards, you have to make this reduction in certain cases. Okay, we'll be talking about that in a while. Now, there are certain provisos which are attached to section 48. Provisos means what? I hope everybody knows that. Provisos means exception. This first proviso is a very important proviso, and for whom it is applicable and what this proviso exactly wants to say. Let us talk about that. This proviso is applicable to non-residents and foreign companies when they buy shares of Indian company, when they buy debentures or bonds of Indian company, not Indian government, of Indian company, not RBI, of Indian company, not state government. They have to buy shares, debentures or bonds of Indian company. Okay. Is government company fine? Government company is fine. Government company is also Indian company only, but government would not be covered over here. But RBI would not be covered here. State government would not be covered over here. Okay. So when non-resident buy these assets in foreign currency in India, in which currency? In foreign currency, then the capital gains has to be computed as per rule 1158. How the capital gains has to be computed? As per this. You have to convert all your sale consideration, cost of acquisition, expenses on transfer, and then ultimately the capital gains as per this rule. First of all, sale consideration and expenses on transfer will be converted at the same rate. You have to take the average of telegraphic transfer buying rate and telegraphic transfer selling rate divided by 2 on the date of transfer on the date of transfer. For both of them, you have to convert them at the average TTBR and TTSR on the date of transfer. For cost of acquisition, you have to take again average, but now on the date of purchase. For these two on the date of transfer, for cost of acquisition on the date of purchase. Once you do this, you will get a capital gains which is in foreign currency. Once you get the capital gains on foreign currency, then you have to reconvert that into INR. Okay, you have to reconvert that in INR. So how will you reconvert that? At that time, do not take average. Just take buying rate, TTBR on the date of transfer. So just a buying rate, not average on the date of transfer, not on the date of purchase. So you will be given question in INR, you convert that into dollars as per this. And then when you ultimately get the answer in dollar, then again reconvert into rupees. Okay. For whom it is applicable? It is applicable to non-resident foreign company who buy shares or debentures or bonds of Indian companies, not of Indian government, as I have told you earlier, in foreign currency. Okay. This provision is applicable even when you reinvest the shares in India. Suppose if you bought for the first time the shares of Indian company and then you sell that and then you got the money, then you again reinvest, then also this provision is applicable. Okay. The next point I have told you, this provision is not applicable to UTI, mutual fund or business trust units. It is only applicable to shares or debentures. Okay. This provision is applicable to unlisted shares and listed shares both. But listen carefully, this is a very important point. The equity shares which are covered in 112A, equity share, if it is covered in 112A, then this provision is not applicable to the assessee. If it is covered in 112A, what is covered in 112A? The stock market wala equity share, stock market on which STT is paid. So if the equity share is covered in 112A, long-term capital gains is covered in 112A, stock market wala long-term capital gains on which you have paid STT, then this provision is not applicable. First proviso is mandatory, it is not optional. The moment you follow the first proviso, second proviso is not applicable. What is second proviso? Second proviso is about indexation. So all those assessees which are covered in this particular provision, for them indexation benefit is not available. Okay, indexation benefit will not be available to the assessee. This proviso is applicable to both short-term and long-term capital gains, but if it is long-term, you will not get the indexation as I have told you over here. Okay. Now coming to the next point, indexation for your financial year is 317. I hope you might be knowing it. Indexation is applied to all the assets except all the long-term assets except to bonds and debentures. Bonds and debentures are not subject to indexation. I hope you know that. Indexation is also available to UTI, mutual fund and business trust. But again, listen carefully. If your shares or mutual fund is covered in 112A, then indexation is not available. 112A asset do not get indexation. 112A asset will not be covered in first proviso also. Okay. Then is there any bond on which I can get indexation? Yes, there are two bonds on which you can get indexation. One is capital index bond and second is sovereign gold bond. These are the two exceptions where you get the indexation under the income tax law. Okay. Benefit of indexation is available on equity share, preferences, everything. Don't worry about it. Okay. And last but not least, except which is covered in 112A, you will not get indexation as I have told you just now. No STT, no deduction of STT shall be allowed. STT will not be allowed. In PGBP, it will be allowed if your stocks are considered as what? As your securities, as your stock in trade. If the securities, the shares which you are purchasing is considered to be stock in trade, then you can claim the deduction of STT in PGBP under section 36, subsection 1, clause 15. But in capital gains, STT is not allowed, not allowed, not allowed. When you purchase shares, do not add to the cost. When you sell shares, do not reduce from the sale consideration. Okay. This proviso will be looking at along with section 47 and section 10. Okay. Now coming to this landmark judgment of Supreme Court which came in 1981, B.C. Srinivasa Sethi. Now what has happened in this case? The assessee has transferred some business. And while transferring the business, the assessee has also transferred some self-generated goodwill, his own goodwill. And the assessee did not pay tax on this. The reason why the assessee did not pay tax on this is assessee said that the cost of acquisition cannot be determined for self-generated goodwill. How will you determine the cost of acquisition for the self-generated goodwill? Suppose there is some goodwill of mine. How will I determine what is the cost of that goodwill? I have not acquired that from somewhere. It is self-generated. So how will you determine a cost of acquisition of a self-generated goodwill? So the assessee said that, department said that the cost is nil. Assessee said that where it is written the cost is nil. Nil is also a number. It should be written somewhere in the definition of cost of acquisition, and the cost of acquisitions are generally defined in section 55 and section 49. The assessee asked the department where it is written that in section 55 that the cost of acquisition of self-generated goodwill is nil. The department said that it is assumed. Nothing is assumed in computation mechanism. Assessee said that the cost of acquisition is not nil, it is not applicable. And the assessee said that because the cost of acquisition is not applicable, the computation mechanism of the department fails. And if the computation mechanism fails, charging section cannot be effectuated on the assessee. That is what this landmark judgment has to say in 1981. Immediately after this landmark judgment, the government amended the definition of cost of acquisition and said that if there is a goodwill of a business or profession or trademark or brand name associated with business, or right to manufacture, right to process any article or thing, or right to carry on any business or profession, or tenancy rights, or loom arts, or stage carriage permits, all these things, if it is purchased from someone, then you will take the purchase price as cost. If I purchase goodwill from someone and then I am selling, then the cost of acquisition of goodwill will be purchase price. But if I have not purchased, but if I have done what? If I have self-generated that, then in that case you have to take nil. Check over here. So now, if you buy these things from someone, then the cost will be purchase price. But if it is self-generated, then the cost will be what? Nil. Now, till last year, the word profession was not used over here. The word profession was not used over here. These two words, profession. Earlier, only self-generated goodwill was covered. Profession was not covered. But from Finance Act 2021, there is an amendment whereby now even the professions are covered over here. Okay, can you see this over here? Similarly, for improvement also, there is a similar thing. Cost of improvement, obviously, on this will be nil only. And if it is self-generated, then also nil. What cost of improvement you will make on goodwill? You cannot make any cost of improvement on goodwill, obviously. So purchase cost will be purchase price if purchased. If self-generated, then nil. Sorry. And cost of improvement will always be nil, whether you have purchased or whether it is self-generated. Okay. Any other asset apart from this will always be subject to what? Actual expenditure. Actual expenditure. Okay. Anyways, let us go ahead. Now, all these assets All these assets, I am circling it properly. Look at them properly. All these assets, whether purchased or whether self-generated, the FMV as on 1/4/2001 is not available on these assets. There is one more place where the FMV is not available, that I will speak sometime later. But there are two places total in income tax law where FMV as on 1/4/2001 is not available to the assessee. This is one amongst them. Next, what is the cost of acquisition of a bonus share or bonus unit? By default, the cost of acquisition of a bonus share and bonus unit is nil. Okay. But if the bonus shares or bonus units are allotted before 1/4/2001, then the FMV of that particular unit will be considered, or shares will be considered as the cost of acquisition. In that case, the cost will not be nil. Please keep this thing in mind. Okay. Now, let us talk about when an asset will be short term and when an asset will be long term. An asset is short term generally if it is held for up to 36 months. If an asset is held up to 36 months, and how the period of holding will be count? It will be count from the date of purchase till one date prior to the date of transfer. Suppose if you transfer on 15th November 2023, then you have to count till 14th November 2023. Please keep this thing in mind. From date of purchase to one date prior to the date of transfer. Generally, if this period is up to 36 months, it is up to 36 months, then it is short term. If it is more than 36 months, then it is long term. Okay. Now, in some cases, your asset will become long term immediately after 12 months. Now, what are those cases? Those cases you have to buy hard. First of all, listed shares, equity or preference. If there are listed shares, equity or preference, those shares will become long term immediately after 12 months. They will not take 36 months to become long term. Second, listed securities. Listed securities means debentures, bonds, etc., which are listed. They will also become long term after 12 months and not after 36 months. Third, units of UTI, equity oriented mutual fund. They will become long term, listed or unlisted both. They will become long term after 12 months and not after 36 months. Zero coupon bond, listed or unlisted both. So this is listed, but last two are listed and unlisted both. They will become long term after 12 months itself. Now there are two assets which will become long term after 24 months. One is land and building. Land and building will become long term after 24 months, and equity shares or preference shares which are unlisted, because listed are covered over here. So unlisted will become long term after 24 months. I hope everyone is clear with this. Okay. Now, what is the cost of acquisition in case of right shares? Suppose the company gives you a right and you renounce that right in favor of someone. Then the cost of acquisition of the right which is renounced is nil. So suppose you renounce that right in the favor of your friend and your friend paid you 5,000 rupees. So 5,000 will become your sale consideration, but the cost of acquisition will be zero in this case. Okay. Now, whenever your friend will purchase the shares, and then later on if he will sell the shares in the market. So when your friend will purchase the shares, who has taken the rights from you, for your friend there will be two costs. One cost which he has paid to me to acquire the right, and second cost which he has paid to the company to acquire the shares. So for him, there will be two cost of acquisition. Okay. Last but not least, generally you have to take FMV as on 1/4/2001 if you have acquired the asset before 1/4/2001. So if the asset is acquired before 1/4/2001, you have to consider what? The FMV as on 1/4/2001. But in case of land and building, you have to consider FMV or stamp duty value both, and whichever is lower has to be considered over here. You can check over here. In case of land and building, you have to consider FMV and stamp duty value both, and whichever is lower as on 1/4/2001, you have to consider that particular thing in case of land and building. Be very careful about it. Okay. Now, coming to the special charging sections. As I have told you at the beginning of this chapter, there are two types of charging section in this chapter. One is general chargeability, another is special chargeability. Let us talk about the special chargeability. First of all, section 45(1), what does it say? One of the primary condition of section 45(1) was that the gain will be chargeable in the previous year in which the transfer took place. So the gain has to be charged in the previous year in which the transfer took place. Suppose if the transfer takes place in 21-22, then the gain has to be charged in 21-22 itself. But there are four exceptions under income tax law where the gain is not chargeable in the year of transfer, but it is chargeable in some other year. It is deferred to future years. It is postponed to future years. Which are those four cases? You can see these are the four cases: 1, 2, 3, and 4. That is the reason these four are exceptions to your general chargeability, and these four can be considered as what? As a special charging section. So 45(1)(a), what does it say? If you have an asset which is destroyed or damaged because of some reason, and your asset is insured, it's insured with an insurance company, then if whenever this will be, suppose you have an asset which is insured and that is destroyed because of some reason, because of fire, because of earthquake, because of war, because of any other thing, riots, then the amount will be chargeable to tax. You will be charged to capital gains in the year in which you receive the money or receive the asset from the insurance company. Insurance company can either give you money or it can either give you asset. So you will be chargeable to tax in the year in which you receive the money and not in the year in which the asset is destructed. Suppose asset is destructed in 21-22, but you receive the insurance money in 22-23, your capital gains will be chargeable in 22-23. Sir, which will be the year of transfer? Year of transfer will be the year of destruction. That is 21-22. Period of holding, whether the asset is long term or short term, will be counted till 21-22, till that is till the destruction. but gain will be deferred. Taxability will be deferred to 20 to 23. That is the year in which you receive the money. I hope it is clear to all of you. Sir, what about if my asset is not insured? If your asset is not insured, this section is not applicable. Then in that case, it is a capital loss. You have to bear that loss. It's a capital loss. So date of transaction, date of transfer will be date of destruction. That will be date of destruction. Whenever the asset is destructed, you will assume that that is the date of transfer. But it will not be chargeable in that year. It will be chargeable in the year in which you receive the money. I hope everyone is clear. At the same time, if the asset which is destroyed is a part of block, and that asset is destroyed. So if furniture is a part of block that is destroyed because of fire, then the amount of insurance money which you will receive, you will reduce it from the block, as you can see over here. I hope it is clear to all of you. Okay. Let's move on to the next one. That is 45.2. What is 45.2? Try to understand the sequence. You bought a capital asset. Then after a few years, you convert that capital asset into stock in trade. Then the government says that you have to pay capital gain tax. So conversion of SIT into capital asset is also a transfer. But the government says that we will not take tax now. We will take the tax in the year in which you sell the stock in trade. So you bought a capital asset, you converted that into SIT. You will be liable to tax, but not today. When you will sell the SIT, you will be liable to tax under two heads of income. One is PGBP, another is capital gains. So how capital gains will be computed? For capital gains, the sale consideration will be FMV on the date of conversion. And the cost will be the cost of capital asset. Sir, what will be the year of transfer? Year of transfer will be the year in which you convert. Sir, what will be the period of holding from the date of purchase till the date of conversion? Sir, which year's indexation I will take? You will take the indexation of date of purchase and date of conversion. But the taxability will be done in the year of sale of SIT. I hope it is. Taxability is deferred to the year of sale of SIT. So in the year of sale of SIT, you will be taxed under two heads, PGBP and capital gains both. Capital gains will be FMV on the date of conversion minus cost of acquisition. And PGBP will be sale consideration of SIT minus now cost will become the sale consideration of capital gains. Whatever capital gain, whatever sale consideration you have taken in capital gains, well, that will become the cost of acquisition of what? Of the SIT. Of the SIT. I hope it is clear to all of you. Okay. Now the converse case of that. Converse case means what was this case? Capital asset was getting converted into SIT. Now let us convert SIT into capital asset. Say I bought an SIT of 1 lakh rupees and later on I converted that in 24-25 to 5 lakh rupees of capital asset. So now you will be chargeable to tax in this year only. Now there will be no deferral. You will be chargeable to tax in this year under the head PGBP. Because now you are converting SIT into capital asset. When you are converting capital asset into SIT, that time you had to pay capital gains. But when you are converting SIT into capital asset, at that time you have to pay PGBP, and this will be not deferred to the year of sale. In this case, it is taxable in this year only. I hope it is clear to everyone. Unlike the previous case where the taxability of both the head was deferred to the year of sale. Here, capital gains will be charged here, but PGBP will be charged in the year of conversion itself. And what will be the sale consideration? FMV on the date of conversion will become the sale consideration. Later on, when I will sell the capital asset, what will be the cost of acquisition? This 5 lakh, that is the FMV on the date of conversion, will become the cost of acquisition. What will be the period of holding? You will count the period of holding from year to year. That's it. From the year of conversion to the year of sale, that much period of holding will be counted to determine whether the asset is long term or short term. I hope it is clear to all of you. And which year's indexation I will get? Year of sale divided by year in which you convert the asset. You will get the indexation of that year. Okay. Now suppose if I convert this asset into a capital asset and that capital asset is a fixed asset in my business, then what will be the actual cost of that asset? For that, government has made an explanation 1A in section 43(1) and says that if you convert an SIT into capital asset, which is your fixed asset for the business, then in that case, again, this 5 lakh rupees will become what? Your actual cost for the purpose of income tax law. I hope everyone is clear with this. Is it clear? Now 45(3). What is 45(3)? It's a small section where a partner is transferring some assets to a firm or a member is transferring some assets to AOP BOI. If a partner is transferring some assets to the firm or a member is transferring some asset to the AOP BOI, partner will be liable to capital gains, and in case of partner, the sale consideration will be the amount recorded by the firm. Whatever amount the firm records, that will become the sale consideration for the partner. I hope everyone is clear with this. Is it clear? Now let's talk about something big and something important, which is a very important made by Finance Act 2021. High chances of this coming in your exam. Okay. That is section 9B and section 45(4). Let us talk about section 9B first. For that, you need to understand few terms first. Specified entity. Who is a specified entity? It is either a firm or an AOP BOI, generally a firm only. Okay. Who is specified person? The partner of the firm or the member of the AOP BOI. So specified entity is generally firm and specified person is generally the partner. Okay. Now, a specified person is receiving some capital asset or stock in trade from a specified entity. So the firm is receiving some capital asset or stock in trade from the partner. Okay. So in that case, why it is receiving? It is receiving in connection with either of the two things, either dissolution or reconstitution. So I am a firm, you are a partner, I am receiving something from you. Okay. So I am you are receiving something from me. The partner is receiving something from the firm. So the firm is transferring some assets or stock in trade to the partner. Why it is transferring? It is transferring either on dissolution or either on reconstitution. Okay. Now, what is reconstitution? Reconstitution is defined over here as follows. Reconstitution means either of the three things. First, if there is one or more partner who leaves, who retires from the firm, then it is a reconstitution. Or there are one or more partners who are admitted to the firm, then also it is a reconstitution. The first case covers retirement, second case covers admissions. Okay. Third case, there are no retirement, there are no admission, there is a change in PSR of the partners. If there is a change in PSR of the partners, that is also a reconstitution. Okay. So there is some change in PSR and the firm is giving some assets to the partner because there is a change in the PSR, then that is also covered over here. Okay. Then in that case, who will be liable to tax? So the firm is transferring some capital asset of stock in trade. So if the firm is transferring capital asset, then the firm will be liable. Then the firm will be liable for capital gains under 9B. And if the firm is transferring stock in trade, then the firm will be liable for PGBP under section 9B as per 9B. So the firm can be liable under both the heads, other capital gains also and under PGBP also, either of the heads, whatever you are transferring. Okay, if you are transferring both, then you will be liable to tax under both the heads. Now, in what event you are transferring either on dissolution to partner or on reconstitution to partner. Reconstitution I have just explained you. Okay. Now, when it will be taxable? It will be taxable in the year in which the firm has transferred and the partner has received that particular asset, stock in trade or capital asset. Whenever the partner received that thing from me, from the firm, in that year, it will be taxable in the hands of the firm. In the hands of the firm, not in the hands of the partner, because the transfer is made by the firm and not by the partner. When a partner transferred, that is already covered in the previous section, that is 45.3. I hope everyone is clear with this. Okay. Now, what will be the taxable amount for the firm? If a firm is transferring capital asset, okay, or stock in trade, whatever the firm is transferring. If a capital asset is transferred, then capital gains will be charged under 45. If a stock in trade is transferred, then it will be chargeable under PGBP. Then what will be the sale consideration in both the case? FMV of the asset transferred. Whatever is the FMV of the capital asset or stock in trade, that will be considered as what? Sale consideration for the assessee. You can see over here. Is it clear? So this is what your first section is all about. Now there is one more section which the government has brought. Now this section also covers specified person, specified entity. But here the taxability is again on the firm only. Okay. But here the firm is transferring either money or capital asset. The firm is not transferring what? Stock in trade. So previous section has both stock in trade and capital asset. This section has capital asset, but this section does not have stock in trade. Instead of stock in trade, it covers money. And this section is covering only reconstitution. This section does not cover dissolution. Try to understand the differentiation. Previous section had dissolution also, reconstitution also, both the things were there. And this section, both the things are not there. Okay. Now, then in that case, the capital gains will be chargeable. When this section is applicable, 45.4, when firm transfers to the partners either capital asset or money or both on reconstitution, not on dissolution. 45.4 is not applicable on dissolution. Then the firm will be liable to capital gains as follows, as per this formula. What is capital gain? B plus C minus D is the formula of capital gains. You have to add B, you have to add C, you have to minus D. You will get the capital gains. What is B? B is the money received by the firm. Money received by the partner. Whatever partnership firm is giving money to the partner, that will be B. What is C? The market value of the asset. There are two things which are given to the partner under this section, right? Money is covered in B and the value of asset, that is FMV of the asset, is covered in C. And what is D? What has to be minus from that? What has to be reduced from that? What is D? Listen carefully. What is D? D is the amount of capital balance in the partner's account. To whichever partner you are transferring the asset, you have to take that partner's capital account as D. But while taking D, you do not have to take two things. First, you do not have to take revaluation. You can see over here. Ignore revaluation. Ignore revaluation. You are not supposed to take revaluation in the partner's capital account of any asset or due to self-generated goodwill or self-generated asset. These things have to be excluded while taking the capital account. So if there is some revaluation in the capital account, you have to reduce that particular revaluation from the capital account. Okay. And you have to take without that. If the answer to this is 0, a B plus C minus D is 0, then no capital gains will be charged. Okay. Or if it is negative, then no capital gains will be charged. If it is negative, it will not be considered as a loss, which you can carry forward and set off. It will be considered as 0 rupees. Okay. Now, to explain all these things in detail, CBDT has come up with a great circular. So I would like to explain you all that circular again. For that, I have also put a lecture, but that is in Hindi. I guess you won't be able to understand that. So I am not explaining the circular. I am revising the circular. So this entire structure, how it will go, for that purpose, CBDT has given one circular. So I am showing you that circular now. Now, as I have said you all earlier also in previous revision videos, if you have listened to the revision videos in entirety, you would come to know that I have told you, you have to see one extra chapter of extra rules lecture. Do you remember that? You have to see this extra lecture, extra rule booklet from here. Do you remember that? This booklet. So in this booklet, the CBDT has explained in detail. I have also come to this earlier also while explaining the circular with respect to 194Q of TDS. Do you remember that? I have come to this particular slides. So these are some of the circulars which are added by CBDT which are relevant for your exams. Now pay attention please. I am explaining this circular. There are three partners A, B, C in a firm. Each partner has a capital balance of 10 lakh and the book value, and there are three assets, that is three land, S, T and U. Okay. Now all the lands are more than 2 years ago. So there are three partners and there are three lands. So three partners capital account shows 10 lakh and all the land also 10 lakh. So balance sheet tally. 3 land 30 lakhs, 3 capital 30 lakhs. Is it clear? Now one of the partner wishes to exit. He wishes to exit. He wants to go. Okay. That is partner A wishes to exit. Now what has to be done in that case? So what the firm is doing? The firm is revaluing its land on valuation report from the registered valuer, and firm is revaluing the land. ST is revalued at 70 lakhs and U is revalued at 50 lakhs. So two land are revalued at 70 lakh and one land is revalued at what? 50 lakhs. And the land which is revalued at 50 lakhs, it is given to partner A. Partner A, along with that 11 lakh of money is also given to partner A. Okay. So there are three partners, out of which one is leaving, and the one who is leaving, to whom we are giving what? One land which is worth 50 lakhs after revaluation and 11 lakh of money. So in short, I can say we are giving total of 61 lakh rupees to him, right? 11 lakh of money and 50 lakh rupees of what? Land after revaluation. Now, whether 9B will be attracted? The answer is yes. 9B is attracted on reconstitution, yes. And 9B is attracted on what? Transfer of asset. 9B is not attracted on transfer of money. So do not take 11 lakh while computing 9B. But while computing 45.4, you have to take 11 lakh also, because in 45.4, money is covered and capital asset is covered. So now what will be your capital gains? Your capital gains will be 50 lakhs is your sale consideration as per 9B, and assume that index cost of acquisition is 15 lakh because the land is held for more than 12 months, more than 24 months, as it is written over here. All the lands are held for more than 2 years. So take that as what? As 15 lakhs. Assume that is an assumption. So 35 lakhs will be your capital gains. That will be LTCG. Okay. Now this LTCG will be subject to tax. Suppose this is subject to tax at the rate of 20%. Okay. So now this 20% will come to how much? 7 lakh rupees. So the firm has to pay 7 lakh rupees tax as per 9B. Is it clear to everyone? I hope everyone is clear. I cannot do justice with this circular. You should have done this circular. Your respective teacher from wherever you have learned should have taught you all these things. We have taught all these things in our class to our students in detail. We have said, we have explained each and every question to all the students. But if you have not done at your end, it might be slightly difficult to understand this in a revision video. It's not that easy to understand that in a revision video. But still, I am trying my best because it took around 2 hours for me to explain this circular. Now, I cannot explain that in 10 minutes. It's not that possible. Anyways, we are not explaining here. We are trying to revise the things over here. But still, I am trying to explain because most of the people have not done this particular thing earlier. So, this 7 lakh is the tax that the firm has to pay. Now, what is the accounting profit of the firm? Firm had a land of 10 lakh rupees, which is revalued at 50 lakhs. So, the accounting profit of the firm is 40 lakhs. Do you agree? Now, out of that accounting profit, the firm will pay 7 lakh tax, this one, and therefore the accounting profit left with the firm is 33 lakhs. Now, this 33 lakhs will be apportioned to all the three partners, and 11 lakh will be given to all the three partners. This is what is done over here. Okay. Now, if you see the partners A's capital account, earlier partner A capital account was 10 lakh. Now, 11 lakh is transferred after transfer of this land. So, partner A's capital balance is 21 lakhs. Now, coming to 45.4. Now, let's talk about 45.4. 45.4 talks about what? Money B plus C minus D. What is B? B is money. What is money? Money is 11 lakhs. What is C? C is value of asset. Value of asset is 50 lakhs. And what is D? D is this particular thing. That is amount available in what? In the capital account. That is 21 lakhs. Okay. So if I add B plus C minus D, I will get what? I will get 40 lakh rupees. That is 61 minus 21. This 40 lakhs rupees will be chargeable under 45.4. Okay. I hope it is clear to all of you. Now the question is, what will be the nature of this 40 lakh rupees? The nature, whether this 40 lakh rupees which is chargeable under 45.4, is it long term or short term? How will I determine that? For that, government has made a rule, and government says that you have to attribute this 40 lakh rupees to the remaining asset available with the partnership firm. Now, what are the remaining assets available with the partnership firm? The remaining assets available with the partnership firm is 2 assets, and it has to be attributed in the ratio in which those 2 assets are revalued. At what value those 2 assets are revalued? Remaining assets are revalued at what? At 60 plus 60, right? So they are revalued at the ratio of 1:1, right? The remaining 2 assets are these 2 assets now. S and T. It's not that easy to explain this. S and T are the remaining 2 assets. So you are going to attribute your 40 lakhs to the remaining 2 assets in the ratio in which they are revalued. So what is the ratio in which they are revalued? They are revalued in the ratio of 60 is to 60. That is 1:1. So you will attribute 40 lakhs to that, 20 lakhs to first land, 20 lakhs to second land. And the land to which you are attributing, those land, if the assets to which you are attributing, if those assets are long term, then this 40 lakhs will also become long term. If those assets to whom you are attributing, if those assets are short term, then this asset will also become short term. So this 40 lakh is attributed to land, both of them are long term, therefore this 40 lakhs will also become what? Long term. Now once this is attributed to both of them, what will happen? Whenever those two lands will be sold by the firm later on, whenever those two land will be sold by the firm later on, say firm will sell this land for 200 lakhs later on, so this 20 lakh which is attributed to them will be reduced from their sale consideration later on, and that was the reduction which is covered in section 48. As I've told you, 48 has one more reduction which is made by Finance Act 2021. So this amount which is attributed to the remaining asset will be reduced from what? Will be reduced from the sale consideration later on. From what? From the sale consideration of the remaining two land. Which are the remaining two land over here? Remaining two land is S and T. Now for more information, I cannot say more than this in this revision video because it is not practically possible because of time constraint. For more information, you can go through the circular entirely, or you can, if possible, listen to my Hindi video, if possible, if you can understand Hindi. Okay. So now let's go ahead with back to the main textbook. That is the next part. Pay attention, please. In case the business is discontinued, that is dissolved, then how the stocks will be valued? Stocks will be valued in the normal way. That is in the value, in the way that it is valued. That is, it will be valued in the form of net realizable value. You can see over here. In case of dissolution of a partnership, firm, or association of person or body of individual, notwithstanding whether the business is discontinued or not, the inventory on the date of dissolution shall be valued at what? Net realizable value, that is NRV. You will value the inventory at NRV only. Okay. Now let's move on to the next charging section, that is 45.4. Again, in this charging section, capital gains is not chargeable in the year in which the asset is transferred, but it is chargeable in some other year. It is deferred to future year. So suppose the government is compulsorily acquiring your property. So when will the capital gains be chargeable? It will be chargeable in which you receive the original compensation or the part of the compensation. Suppose the original compensation decided is 10 lakh. Even if you receive 1 lakh out of that 10 lakh, then entire 10 lakh will be chargeable in the year in which you receive 1 lakh, because the law uses the word the original compensation is received in part or in full. So if you receive the part of the original compensation, the entire original compensation will be chargeable in the year of transfer. So the year of transfer will be considered as which year? The year of transfer will be, in the year of receipt, you will be chargeable to tax. So year of transfer will be the year of compulsory acquisition. Period of holding will be counted till the year of compulsory acquisition. Whether the asset is long term or short term, till the asset is acquired by the government compulsorily. Indexation will be available till the asset is acquired by the government. But the taxability will be deferred in the year in which you receive the part of the first compensation. So the taxability is deferred in the year of receipt. Later on, if I receive some enhanced compensation, then what? When it will be taxable? Again, it will be taxable in the year of what? In the year of receipt. What will be the nature of enhanced compensation? The nature of enhanced compensation will be same as the nature of original compensation. If original compensation is long term, then enhanced compensation is also long term. Is there any reduction of cost I will get from enhanced compensation? Yes, you will get one reduction if you incur any cost, if you incur any legal cost. For what? For the purpose of earning that enhanced compensation. Obviously, for earning that enhanced compensation, you would fight a case in the court. So if you are fighting a case in the court and you are earning some income, you are incurring some expenses on that particular case. So you will get the deduction of that particular expenses on legal charges. Okay. Now, in the meanwhile, if I receive any interest from the government on my compensation, because the government is not paying me the compensation on time, so they are giving me some interest. Will I be chargeable to tax on that? Yes. That interest is chargeable to tax under IFOS, and that interest is subject to standard deduction of 50%, as you can see over here. Whatever interest you will receive, flat 50% will be standard deduction, and that will also be chargeable in the year in which you receive that interest. In whichever year you will receive the interest, it will be chargeable to tax in that year. Okay. Now, suppose I am fighting the case and in the meanwhile I am dead. Then what will happen? Suppose you are fighting the case and in the meanwhile you are dead. Then in that case, the income will be chargeable in the hands of the legal heir. Whomsoever is your legal heir and whomsoever receives the enhanced compensation on behalf of you will be chargeable to tax in that person's hands. Okay. I hope it is clear to all of you. Now there is one small section 155.16, not much important for exam. That's the reason I'm not saying much about it. Next, joint development agreement. What is joint development agreement? I have a building and a builder is coming with a proposal to me and saying that give me this building and I will give you money. I will give you new flats in the new building. I'll redevelop this building and I will give you flats in this. This is a very common process. So in this case, if the builder is taking my building today and giving me money today and giving me flats after 5-6 years, I cannot pay tax today because most of the flats I will receive after 5-6 years. So the government has deferred the taxability to the year of completion of the project. So the government has said that assessee will pay tax in the year in which the project is completed. So now this section is only applicable for individuals and HUF. The assessee who is individual and HUF. If the assessee is company, this section is not applicable. If the assessee is a firm, AOP, BOI, then this section is not applicable. Assessee has to be a company. Assessee has to be individual or HUF. And assessee should own a land or building or both, and the possession of land or building, etc., has to be given to the developer. And in return, what the developer is giving? Developer is giving you either flats later on, or he is giving you flats along with money. He should give either of the two. Either he should give flats, only flats, or flats plus money. If he is giving you only money, then this section is not applicable. Then there is no genuine hardship on you. If you are giving the building today and he is giving you entire money consideration, then there is no genuine hardship. Pay tax today itself. But if he is taking the building and he is giving partly money, partly in kind, or wholly in kind, that is wholly in flats, then this section is applicable where the taxability will be deferred to future years. Okay. Now, what will be the taxable? When it will be deferred? To when it will be taxable? It will be taxable in the year in which the project is completed. You can see over here. Whenever the project is completed, in that year it will be taxable. It will not be taxable. Suppose you are transferring the land or building in 21-22 and the project is completed in 25-26. So it will be taxable in 25-26, not 21-20. What will be the sale consideration? The sale consideration for me would be, I am an individual or HUF, because this section is only applicable to individual HUF. The sale consideration for me will be stamp duty value of whatever I receive, whatever flats I receive, plus the money which I receive. The total of two will become sale consideration. Okay. What if I sell this particular flats later on? The new flats which I have got, if I sell that later on, then this amount which is taken as FVC over here will become the cost of acquisition later on. Suppose the FVC over here is, I receive 2 crore rupees as cash and 10 crore rupees as the value of the houses. So 12 crore is the total value which I have received. So this will become the cost of acquisition later on whenever I will sell the houses. Is it clear? Now this benefit of deferral is available only if you do not transfer your rights till the year of completion. So suppose today you give the land to the builder and builder has committed that he will give you houses in 2015, 25, 26. That is after 4 to 5 years. But you need money and you are transferring the rights in 24, 25 or 22, 23. That is after 1 or 2 years you are transferring your rights. Then you will be liable to tax in that year itself. Then your taxability will not defer till 25, 26. Okay. So you have to wait for the builder to give you the project ka part. So if you transfer in between, then you will be liable to tax in between only. Okay, I hope it is clear. Last but not least, whatever builder is giving you in monetary consideration, not in kind, in monetary consideration, not in kind. So he will deduct TDS at the rate of 10% if the assessee is what? Resident. If the assessee is resident, he will deduct TDS at the rate of 10%. If the assessee is non-resident, then he will deduct TDS as per section 195. This section is not applicable for non-resident assessees. I hope it is clear to all of you. Is it? Now let's talk about the next one, which is again a very important amendment made by Finance Act 2021 for ULIP, ULIP and ULIP. If a ULIP is issued before 1st Feb 2021, then only one criteria was supposed to be checked to claim exemption, and that is whether the annual premium exceed 10%, 15%, 20% in some cases. You might be knowing that criteria. If the policy is issued between 2003 to 2012, then the annual premium should not exceed 20% of sum assured. And after that, it was 10%. And after that, it was 10% for normal people and 15% for disabled person. But there is one more criteria now the government has put. If the ULIP is issued on or after 1st Feb 2021, listen this date carefully. If the ULIP is issued on or after 1st Feb 2021, there is one more criteria that the government has put. And what is that criteria? Along with the percentage criteria that you have to fulfill, your annual premium should not exceed 10% of sum assured in case of normal person, and in case of disabled person, your annual premium should not exceed 15% of sum assured. That you have to fulfill. Along with that, your annual premium should not exceed 2,50,000 rupees in a financial year for any of the previous year during the life of the ULIP. This is applicable. So now you also have to consider percentage along with the absolute amount. Percentage has to be checked and then the absolute amount. So this has to be done what? If the policy is issued after 1st Feb 2021. What if I have more than one ULIP? If I have 2 ULIPs, if I have 3 ULIPs, if I have 4 ULIPs, then you have to select out of them which you want to exempt, and the total premium of those ULIPs should not exceed 2,50,000. Suppose you have 4 ULIPs of premium of 80,000, 80,000, 80,000, 80,000. Now if I total 4 premium, then it will exceed 2,50,000. So you have to consider only 3 out of them, whichever is more beneficial for you, because the premium of 3 will not exceed 2,50,000. Premium of 3 will be 2,40,000 and you can enjoy the exemption. This is how you have to take. One is written in 4th proviso, another is written in 5th proviso. And if your premium exceeded 2,50,000 individually or aggregate, then your ULIP will not be exempt. It will be taxable under section 45(1)(b). And how will be taxable? Whatever is the amount received by you is the sale consideration, and whatever is the annual premium you have paid over the year, that will be your cost of acquisition, and the differential amount will be your capital gains, and it will be chargeable under section 112A at the rate of 10%, subject to 1 lakh exemption. Because in 112A you are supposed to get an exemption of 1 lakh rupees. So be careful. If the annual premium exceeds 2,50,000, then you will be liable to tax as per 45(1)(b). Now, this provision is not applicable if you receive the money on death of the assessee. If on death of the assessee, if the legal heir of the assessee receives the money, the nominee of the assessee receives the money, then it is not taxable even if the premium is more than 2,50,000 rupees. So you have to select out of 4-5 cases. So there are 5 premium, there can be 5 ULIP, there can be 6 ULIP. If it is issued on or after 1st Feb 2021, the aggregate premium also should not be more than 2,50,000. If it is exceeding 2,50,000, then you have to select those annual premium, those policies whose aggregate premium, if you take aggregate, then those aggregate premium should not exceed 2,50,000 rupees. I hope it is clear to all of you. One last thing in this particular chapter, that is reference to valuation officer. The AO might require the help of valuation officer. So he can go to valuation officer for determining the FMV of the asset, for determining FMV as on 1/4/2001, etc. There are a lot of places where FMV is used in capital gains. So AO might require the help of the assessing officer, of the valuation officer. So when he can go? He can go to the registered value. He can go to the registered valuer when he feels that there is variance in FMV. There is a variance in FMV. He can go to the FMV. You can go for FMV when he feels that there is more than 15% variance. There is a variance of more than 25,000 rupees in absolute number. Or whenever he can go for as per his whims and fancies. He can go depending upon the facts and circumstance of the relevant case. So government has given him absolute power. These are some of the parameters. He may or may not follow them. It's all fine. So at the end, the government has said that in case of relevant circumstances, he can go for what? He can go for the valuation to the valuation officer. I hope it is clear to you. Okay. So let's go ahead with the next part, and that is section 50C, that is the deemed value of consideration in case of land and building. So if you transfer land or building or both, then in that case, your sale consideration will be higher of what? It will not be actual sale consideration, but it will be higher of your actual sale consideration or stamp duty value, whichever is higher. But now there is an amendment which is made by Finance Act 2020, whereby it says that this provision is applicable only when the difference between your actual consideration and stamp duty value is more than 110%. It means if your actual consideration is 1 crore, then your stamp duty value has to be more than 1 crore 10 lakh. Then only this provision is applicable. Otherwise, this provision is not applicable. I hope it is clear to all of you. Now, suppose the actual consideration is 1 crore and your stamp duty value is 1.5 crore. Then this provision is applicable because the difference is more than 110%. Okay. So now, if you are not satisfied with the stamp duty value, you feel that the stamp duty value is too high. So you have two options in life. First option is you can go to the tribunal or court and you can file a case against the government, against the state government, and you can say that the stamp duty value is too high. Please try to manage this particular stamp duty value. It is not possible for me to pay taxes on such a high stamp duty value, and accordingly they might increase or they might reduce the stamp duty value. This is one of the options which is available with the assessee. Which is the second option which is available with the assessee? The second option which is available with the assessee is that you can go to the income tax officer. You can go to the assessing officer, and accordingly the assessing officer will transfer your case to the departmental valuation officer. And if the departmental valuation officer's value is greater than stamp duty value, then your value will be stamp duty value. And if the departmental valuation officer says that no, it is lesser than stamp duty value. In my example, the stamp duty value is 1.5 crore. If the departmental valuation officer says that the value is 1.8 crore, then the value will be 1.5 crore. But if he says that the value is 1.3 crore, then the value will be 1.3 crore. Now, there is one important thing which most of the students miss over here. If the actual consideration is 1 crore and the stamp duty value is 1.5 crore, and the matter goes to departmental valuation officer, and if the departmental valuation officer says that the value is not 1.5 crore, but it is 1.05 crore, it means it is 1 crore and 5 lakhs. Then in that case, you just make sure that this section will not be applicable only. The reason being, because now the departmental valuation officer has reduced the value below 110%. Now, because he has reduced the value below 110%, in that case, the provision, the main provision itself is not applicable. So forget about this particular provision. So even the departmental valuation officer has to keep the value above 110% if this provision is supposed to be made applicable. Okay. Now, the one next thing over here is, suppose today is the date of agreement, and in future there will be date of registration. And suppose this date of agreement and date of registration does not fall on the same date, it differs on different date. Then in that case, I am supposed to take the stamp duty value of which date? Of date of agreement or of future date, that is the date on which I registered the property. I can take the value of date of agreement subject to two conditions. First, I should receive an advance on date of agreement or before that. Even if I receive 10,000 rupees, it's fine, whatever amount. But it should be received in the form of advance on the date of agreement or before that. And the second condition is you should receive the advance by account pay check, account pay draft, ECS or such other electronic mode. So on the date of agreement, if you receive or before that, if you receive an advance and that too in the four modes as I've said you, then you can take the value on the date of agreement. If either of the conditions are not fulfilled, then the value will be of the date on which the property is registered. Okay, this is a very important proviso which we need to keep in mind, because based on this, your stamp duty value can differ, and if your stamp duty value differs, your answers will differ in the exam. Okay. Next, what is the fate of those transactions which are not registered? It is not necessary that all transactions which are there under the immobile property which are done in the market are supposed to be done through a registered transaction. Suppose if a transaction is not registered, then there is no stamp duty value which is paid. Then in that case, you have to assume that if you would have done a transaction, then on what value you would have paid a tax. So whatever value you would have paid the stamp duty, that value will become the stamp duty value. So many people do not register their property. So in case they do not register, then you have to assume that. In case they assume, then what would have been the value? That value will be taken as what? As deemed value of consideration for the purpose of income tax law. Okay. That's it. That is something which is there in this particular section. Now let's move ahead towards the next one, that is 50 CA, which is applicable to unquoted shares. If you sell unquoted shares, unlisted shares, then here also the sale consideration has to be sale consideration compared with FMV, whichever is higher. Whichever is higher will be considered as your sale consideration. And in case of buyer, I am the seller, the provision is applicable to the seller. But in case of buyer, for buyer, if the difference between the FMV and the selling price is more than 50,000 rupees, for him it will be considered as taxation of gift under 56 subsection 2 clause 10 IFOS, because he is receiving the shares for inadequate consideration. Okay, you can see this particular provision over here. This is the interlinking that we have tried to do over here. Now this section is not applicable to certain classes of person. And which are those classes of person? Those classes of persons are those classes of person who are covered in section 79. Who is covered in section 79? Section 79, if you remember by any chance, I have explained you certain exceptions in section 79, whereby the National Company Law Tribunal will cancel your registration of the company, will remove the board of directors, will issue shares to the new shareholders. So in that case, if the shares are purchased and transferred, in that case the provisions of 50CA is not applicable. Okay, now nothing much important in that case. Next one, F50D. What does 50D talks about? 50D talks about, so if you are not able to compute your sale consideration for any damn reason, if you are not able to ascertain your sale consideration, in that case, you have to take what? You have to take your sale consideration as FMV of the asset transferred. Whatever asset you are transferring, that will be considered as your sale consideration. So if I am transferring shares, but I am not able to understand what will be the sale consideration of this, it is not ascertainable. So in that case, take the FMV of the shares transferred. Whatever you are selling, take the FMV of that as sale consideration. Okay. So this is what is given in section 50D, a very small section. Okay. Nothing much important again. Now coming to something very, very, very important. The first thing is slum sale. Very important provision. Extremely important provision. In May 22, there was one question of 8 marks asked directly on slum sale in the MCQ. Okay. So it's a very important provision. Don't be under an impression that because it was asked in May 22, so it will not be again asked in November 22. Don't be under an impression. Don't underestimate ICAI. ICAI is meant to do something which is unexpected always. So pay absolute attention and do not ever think of missing this provision before the exams. Okay. So what is slum sale? First of all, it is defined in section 242C. Slum sale talks about one very important aspect, that is, you are transferring one of the undertaking of your business. You are transferring one of the division of your business. Suppose there are multiple divisions in your business and you are not satisfied with one of the divisions of the business. So you are transferring that particular division to someone. So whatever profits will arise out of that particular transfer of a division, you are not selling an asset. You are selling the entire undertaking. You are not selling the entire company. Neither you are selling the entire company, nor you are selling one asset. You are selling something in between. That is a part of the business. So what is slum sale? Slum sale means transfer of undertaking of a business without assigning individual values to any asset and liability. You are not interested in assigning individual values to any asset and liability. You are selling for a lump sum. You are selling for a lump sum consideration. That is known as slum sale. Now there is a very small amendment which is made over here. What used to happen earlier? Earlier, only one transaction was covered over here. That is slum sale. That is only if I sell my undertaking and somebody give me money. Only that was covered. But now, if I sell my undertaking and if somebody give me in exchange of that something, then that is also covered. So rather now you can call this is not a slum sale, this is a slum transfer. The word sale is a very narrow word. The word sale is a part of transfer, but the word transfer is a wider term which includes sale. So earlier there was only sale which was included in this particular section, but now all kind of transfers are covered under this section. Even if I exchange my undertaking with someone for something else, then that is also a slum sale in the eyes of the law. So this is a very important amendment. They have removed the word sale over here, you can see, and they have put the word transfer over here. I hope it is clear to all of you. Okay. Now, the second thing, as I've told you, individual values to assets and liabilities should not be given. You should sell as a lump sum. But if you assign individual values to land and building only for the stamp duty purpose in your agreement, that is allowed because that is a mandatory state government requirement. Okay. Now, slum sale. How slum sale has to be computed? Whether the slum sale gain will be long term or short term, how it will be computed. That depends upon the period of holding of the undertaking. If you are holding the undertaking for more than 36 months, if the undertaking is older than 36 months, then your gain will be long term. If it is up to 36 months, then your gain will be short term. Okay. In slum sale, whether you do not sell stock or land or building, you sell the entire group of assets. So you do not segregate the classification of asset, that if I am selling land, then long-term capital gains. If I am selling depreciable asset, then short-term capital gains. If I am selling stock, then PGBP. You don't have to do all those calculations in slum sale. You have to directly do the calculations. How? The calculations will be done like this, and you will not get any indexation in slum sale. Indexation is not allowed in slum sale. Before this, indexation was not allowed in first proviso to 48. If you remember that non-resident wala case. First provision to 48 is not subject to indexation. Even slum sale is not subject to indexation. How to compute slum sale? Nothing but as follows. Slum sale means sale consideration minus cost of acquisition. What is cost of acquisition? Cost of acquisition is the net worth of the undertaking. What is net worth? The most important part in this section is the net worth. What is the net worth of the undertaking? The net worth of the undertaking is as follows. Listen carefully, all of you, please. The net worth of the undertaking will be as follows. You will divide the net worth into two parts. All assets minus all liabilities of the undertaking transferred. Liabilities will be taken at book values. Liabilities will be taken at book value. Balance sheet value has to be taken for liabilities. Contingent liabilities has to be ignored. Do not take contingent liability. Coming to asset. Assets will be categorized into four categories. First, depreciable asset. For depreciable asset, take the income tax WDV. For depreciable asset, plant, machinery, goodwill, plant, machinery, furniture, intangible asset. Plant, machinery, building, furniture, intangible asset. Take the WDV of the income tax as per 43(6). For non-depreciable assets, take the book value. Do not take revaluation. Do not take market value for non-depreciable asset. For 35AD asset, if you are transferring a 35AD asset, take nil, and self-generated goodwill will be taken as also nil. That is an amendment made by Finance Act 2021. So if you are transferring a self-generated goodwill, then not acquired by assessee from previous owner. It means it is a self-generated. Then you have to take that value as also as nil. Okay. If you do all these things, you will get the total of all assets. As I have told you, WDV for depreciable asset, and then book value for other assets, then nil for what 35AD assets, and for goodwill, which is self-generated, then that also has to be taken as nil. This will give you the total of all assets minus total of all liabilities will give you the slum sale. Now there is one more amendment which is made by Finance Act 2021. Is slum sale mandatory? First of all, no. It is optional. If you want to individually sell the assets, you can sell that. If you want to sell in a lump sum, you can sell as per lump sum. Whatever you want to do, you can do an option. Okay, whatever is the loss and UAD of the undertaking which is getting transferred, what will happen with that loss? That loss and UAD will not be transferred to the other company. That loss and UAD will be carried forward and set off by the existing company itself. That will not be transferred to the other company. Please pay attention on that. Now coming to something important. Can you see this slum sale consideration? Now government says that even this consideration, that is the sale consideration, should also be determined as per prescribed rules. So you have to determine the consideration also as per the prescribed rules, and for that we will go to that extra sheet where the extra rules are given. Okay. So here come the rule. Which rule it is? Pay attention on the board, please, all of you. This is rule 11 UAE. Okay, which talks about what? Which talks about what will be the sale consideration. So the government says that now the sale consideration will be 2 FMV, whichever is higher. Now I will give you the gist of both FMV. The first FMV is of the assets. Listen carefully, which we are transferring to the other undertaking. You have to take the FMV of that. And FMV2 is the assets or the money which we will be getting from the other company in return of what we have given them. So FMV1 is the assets which we have given them. You have to take the FMV of that. And FMV2 is the money and the asset which we have got from the other person. Okay. So FMV1 is the asset transferred. Whatever we have transferred, we have to take the FMV of that. The government has categorized all the assets into 4 categories: A plus B plus C plus D minus the liability. That will give you the sale consideration. Okay. Now what is A? What does A includes? A includes all the assets, but other than jewelry, artistic work, shares and security, and immovable property. Why? Because jewelry and artistic work will be valued at the market value. Okay. Shares and securities will be valued as per rule 11 UA, and the immovable property will be valued as per stamp duty value. The 3 things which are excluded over here are covered here, and here. Okay. One is valued at market value, another is valued at as per the rule 11 UA, and third one is valued as per the stamp duty value. Okay. Okay. Now, so I have circled the value at which they are going to be valued. Apart from that, whatever assets are there will be valued at book value. Will be valued at what? Book value, book value, book value. Whatever, except these three assets, all assets will be valued at what? Will be valued at book value. But do not take any income tax in that, and do not take any fictitious assets in the total assets. When you take the total of all the assets, ignore two things. Do not take income tax like advance tax, etc., and do not take any fictitious assets. Okay. Then what is liability? Liability will include all the liabilities at book value, again at book value, but it will not include certain things. It will not include the following. It will not include paid up capital. It would not include any amount set apart from dividend on preference shares and equity shares which have not been declared. Okay, it will not include reserves and surplus other than those set apart for depreciation. It means this will be included. These are not included, but in this exclusion, if there is some exclusion, there is an exclusion in exclusion, then that will become inclusion, right? So this is an exclusion. In that there is an exclusion. It means this will be included, right? Be very careful. Again, income tax will be excluded. Again, unascertained liability will be excluded. Again, any amount of contingent liability will be excluded. Again, there is an exclusion in the exclusion. It means this will be included other than arrears of dividends payable in respect of cumulative preference shares. You have to remember these things. Otherwise, it is not possible to do this particular thing before the exam. You have to by heart these things. Okay. Now, fair market value 2 is what? What we are going to get. What we are going to get in return of what we have given them. So, first thing which we will get is E. E is money. Whatever money you have received, you have to take that. Then F. F is what? Fair market value of the non-monetary consideration received or accruing as a result of transfer represented by property referred to in Rule 11 UA. Whatever is covered in Rule 11 UA, whatever assets are covered in Rule 11 UA, you have to take the fair market value of those assets. Okay. Okay. So this point is covered for Rule 11 UA assets. Whatever is covered in Rule 11 UA, you have to take the market value as per Rule 11 UA. Now, what is G? What is E? E is the money which you will receive. What is the monetary consideration? And FGH is the non-monetary consideration. Okay. Out of which the first part was FMV of all the assets mentioned in Rule 11 UA. Okay. Now, the assets which are not mentioned in Rule 11 UA, like cryptocurrency, etc., which are not mentioned in Rule 11 UA. For that, you will take the market value. Market value has to be taken from a registered valuer. So this is for assets which are mentioned in Rule 11 UA. This is for assets which are not mentioned in Rule 11 UA. So you will take market value for that as per the registered valuer. And this is what? This is the stamp duty value for immovable property. In case of immovable property, what are you going to take? You will be taking what? The stamp duty value of the property. All these things has to be done on the date of what? Slum sale. So this is what this particular provision is all about. Now let's go ahead with the next thing, that is section 47. We'll be talking about section 47 in a while. But before that, I would like to explain you certain things. Let me talk to you about section 49. What is section 49? Pay attention, please, all of you. If you receive section 49 talks about cost of acquisition. If you receive any asset by way of gift or by way of will or by way of inheritance or by way of amalgamation, by way of demerger, by way of succession, or from holding to subsidiary or from subsidiary to holding. If you receive assets by these modes, then in my case, the cost in my hands will be the cost to the previous owner. And whatever the cost of improvement which has been done by the previous owner, that also will be my cost. And whatever cost of improvement that I will be doing, that also will be my cost. My cost will be three costs. Cost to the previous owner, cost of improvement to the previous owner will become my cost, and cost of improvement in my own hand will become my cost. Whether the asset is long term or short term, to determine that, I will club the period of holding as per explanation to section 2 clause 42 2A. Explanation to section 2 clause 42A. This says that the period of holding of the previous owner should also be clubbed. Now, when it comes to indexation, there is difference in opinion. Suppose I received a gift from my father and then I sell that particular asset. Whether the asset is long term or short term, I will club the period during which the asset was owned by my father. But the question is, indexation will be from when? When my father acquired the property or when I got the property from my father? You get the property from that year also. But if you apply the Bombay High Court judgment of Manjula J. Shah, then you can take the indexation from the year in which your father, that is the previous owner, acquired the asset. You can take that also. That is something which is written over here and which is written in this particular judgment, as you can see over here. Okay. That is the judgment of Manjula J. Shah. Now, there are certain very important issues. This is a very important case law. I'm talking about the first one now. R.M. Arunachalam and also Aditya Kumar Jajodia. Now, what has happened? There was one father who took some property and then he mortgaged that property and took a loan on that. And then suddenly he is dead. So the rights of the property goes to the son because son was the inheritor. Son inherited the property. So son had to pay the loan in the bank to get that property because father has taken the loan, father has mortgaged that property. So son paid the loan and cleared the title of the property. So the question is, will the son get the deduction of that particular loan paid? The answer is yes. This is what is given in this particular thing. Because clearance of title by son, by paying the title, by paying that loan, by repaying that loan is a cost of acquisition to the son, without which the son cannot take the property. So if the son wants to take the property from bank, he has to pay that loan, and therefore this deduction was given to son. Okay. Now, do not extend this deduction to other cases where I took a property, I mortgaged that property, I did not die. Now I am clearing my loan and I want to take the deduction. It is not allowed. It is allowed only if the previous owner has given you a property which has an encumbrance. Encumbrance means there is some problem in the title. There is some encumbrance in the title. So if you have created that encumbrance and you are clearing that encumbrance by repaying that particular loan, then in that case, you are not going to get the deduction. That is what is written in VSMR Jagadish Chandran. Okay, I hope it is clear to all of you. Now, next one. One very important non-taxable transfer of ICA. First of all, let me talk about few non-taxable transfer. Any capital asset transferred by HUF to its members on distribution of the HUF, on partition of the HUF. So if the HUF is transferring assets to the members on partition, then it is not considered as a taxable transfer. It is an exempt transfer. Or if I give someone gift, or if I give someone something in will or in a irrevocable trust, then that is also a non-taxable transfer. If I transfer something in amalgamation, that is also a non-taxable transfer. Now, these two are very important and favorite provisions of ICA. If I transfer capital asset to my 100% subsidiary entity and the other entity has to be Indian entity, then that is not taxable. Similarly, if that 100% subsidiary entity transfers me and I am an Indian entity, the recipient has to be Indian. If holding is transferring to subsidiary, then subsidiary has to be Indian. If subsidiary is transferring to holding, then holding has to be Indian. And there has to be 100% relationship. And this relationship should be maintained for a period of 8 years. And they should not sell the assets for a period of, they should not sell the shares of each other for a period of 8 years. And the recipient entity, whomsoever is receiving the capital asset, should not convert that capital asset into what? Stock in trade for a period of 8 years. So for 8 years, you're not supposed to do two things. First, you're not supposed to sell the shares. 100% ownership has to be there. Wholly owned subsidiary has to be there. Secondly, for 8 years, the capital asset should not be converted into stock in trade. Otherwise, your capital gains exempt earlier will be subject to tax over here as per section 155(7)(b). Okay. Now, coming to the next part, and it is a big one now, which talks about amalgamation. So first of all, we are going to do in-depth analysis of amalgamation. So first of all, we need to understand what is amalgamation. The definition of amalgamation is given under section 2(1)(b), which says that it means a merger of one company with another company subject to following conditions. First condition, all the properties and liabilities of the amalgamating company should be transferred to the amalgamated company. All the properties and liabilities should be transferred from here to there. Second, at least 75% of the shareholders in value, not in head count of the shareholder, in value means in amount. At least 75% of the shareholders should go from amalgamating company to amalgamated company. If these two conditions are fulfilled, then it is a amalgamation. Then you will enjoy a lot of benefits. Benefit number one. What benefits the shareholder of the amalgamating company, that is the shareholder of selling company, will enjoy? Let us try to understand that. So what benefits the shareholders will enjoy now? First of all, whatever shares will be transferred by shareholder of the amalgamating company will be exempt subject to following conditions. They have to give the shares of the amalgamating company, and in return, they have to take the shares of the Indian amalgamated company. They have to give shares and take the shares of Indian amalgamated company. Then their capital gains is exempt. That's it. Later on, when they get the shares of the amalgamated company, they can sell the shares later on. Whenever they will sell the shares of amalgamated company, the cost of acquisition of that share will be the cost of acquisition of the amalgamating company shares. So whatever cost they have paid to acquire the shares of amalgamating company, that will become the cost. Period of holding will be clubbed of the previous company to determine whether the asset is what, long term or short term. This is what is written over here. Now in this case, the government is very clear that you have to give shares and take shares. What if the amalgamated company itself is the shareholder of amalgamating company from the beginning itself? It may happen that amalgamated company is a shareholder of amalgamating company from the very beginning itself. So in that case, the government had said that you give the shares of the amalgamating company, and in return, you cannot give your shares to yourself. Okay. So in that case, you can take money, that is allowed. Okay. So next one, what is the tax implication in the hands of amalgamating company? What will amalgamating company do in the case of amalgamation? Amalgamating company will transfer all the capital assets to the amalgamated company. So whatever capital assets are transferred by amalgamating company to the amalgamated company will be exempt under income tax law under section 47. Exempt, provided the amalgamated company should be an Indian company. Please be very careful about it. Here also the amalgamated company was supposed to be Indian. Here also the amalgamated company is supposed to be Indian company. Now third case, amalgamation of a foreign company. Suppose there are two foreign companies. One is in UK, another is in US. The company in UK is an amalgamating foreign company and company in US is an amalgamated foreign company. And the company in UK, which is an amalgamating company, selling company, holds shares in Indian company. Now suppose that amalgamating company is getting merged with another amalgamated company of US. So in that case, the shares of Indian companies will also be transferred. So Indian government says that we will not take any tax in that case also. When a foreign amalgamating company transfers the Indian company shares to foreign amalgamated company, provided two conditions are fulfilled. At least 25% shareholders of the amalgamating foreign company should be transferred to the amalgamated company. 25% shareholders should go from here to there. And such transactions should not be subject to capital gain tax in the country in which the amalgamating company is incorporated. In my example, UK. Such transaction should not be taxed in UK. If it is taxed in UK, then we will also tax, and then the matter will be solved by DTAA between India and UK. You need to also see a Vodafone case law later on to understand this concept in a better way. Okay. Now, the big one. What will happen with the losses and UAD in case of amalgamation? First of all, 72A will take care of losses and UAD in case of amalgamation. Whatever is the loss of the amalgamating company will be transferred to amalgamated company. Whatever is the UAD of amalgamating company will be transferred to amalgamated company as per 72A. But only the following companies are allowed to carry forward and loss. Only the amalgamation of these companies are covered for the sake of carry forward and loss. If you want to carry forward the loss, then you need to be either of the companies which are mentioned over here. First is industrial undertaking. If there is an amalgamation of industrial undertaking, then only you are covered in this, and only then the losses of the amalgamating company can be transferred to amalgamated company. What do I mean by industrial undertaking? Industrial undertaking means you should manufacture any goods, you should manufacture any software, you should be engaged in this distribution or generation of electricity, you should be engaged in telecommunication network, etc., or any other services like radio paging, like domestic light trunking, broadband network services, and even internet services. You should be engaged in mining, you should be engaged in construction of ships, aircrafts, or rail system. These are the definitions of the term industrial undertaking. So all these businesses, if they are getting amalgamated, they can transfer the loss from amalgamating company to the amalgamated company. Okay. Second, if you are engaged in a business of ship, or if you are engaged in a business of hotel, and if you amalgamate with another company, you will be allowed to carry forward the loss of amalgamating company to amalgamated company. Okay. If there is an amalgamation of banking company, you are allowed to carry forward the loss of amalgamating company to amalgamated company. And if there is one or more public sector company is getting amalgamated with another public sector company, this is an amendment. Earlier, this was only applicable for aircraft business. Now, this benefit is given to all public sector company, and government has said that if one public sector company is getting amalgamated with another public sector company, you will be allowed the benefit. And this is a public sector company's disinvestment. Like Air India got disinvested last year, if you know, and it was sold to Tata. So in this case, if there is a disinvestment of a public sector company with a even public private company like Tata, Tata is not a public sector undertaking. It's a public company, but it's not a public sector undertaking. So in case of disinvestment like this, that will also be considered as what? As a valid amalgamation for the purpose of carry forward and set off of loss. Now, the discussion is very long. 72A is a very big section. There are two conditions which has to be fulfilled by the amalgamating company if the loss has to be carried forward to the amalgamated company. First, the business of the amalgamating company should be at least 3 years old or older than that. It should not be started within last 3 years. So business should be at least 3 years old. And you should go 2 years back. Suppose today is the date of amalgamation. Today is 27th of August 2022. And today is the date of amalgamation. Then you should go 2 years back on 27th of August 2020. And you should see what assets were there with the company. You should take a note of all those assets which were there 2 years back, and at least 75% of those assets should be there today. So whatever assets you had 2 years back, on the date of amalgamation today, you should have at least 75% of the book value of those assets prevailing in your balance sheet. Okay. Then 3 conditions have to be fulfilled by amalgamated company. What are those conditions which are supposed to be fulfilled by amalgamated company? First, the amalgamated company should continue the business for at least 5 years. And if the amalgamated company is an industrial undertaking means manufacturing, etc., then they have to fulfill certain other conditions, like whatever is the utilized capacity of the company, they have to achieve 50% of that utilized capacity in the first 4 years. And in the 5th year, they have to maintain that particular thing. Suppose the utilized capacity of the company is to produce 1 lakh units. So till the 4th year, the company has to reach and achieve at least 50,000 out of it. And in the fifth year, the company has to maintain that 50,000 in the fifth year. Okay. Now, because you are not able to achieve that, you can go and make an application to CBDT. CBDT can relax your conditions. It can increase the period, or it can relax the percentage by reducing the percentage to 30%, 40%, 45%, 25%, whatever CBDT wish to do so. Okay. Next, whatever assets you are receiving, who is receiving the assets? Amalgamated company. Whatever assets are received by the amalgamated company after 5 years from here, today is 2022, 5 years from here will be 2027. In 2027, the amalgamated company should hold at least how much? 75% of the book value of the asset. If all these conditions are fulfilled, you will be allowed to carry forward the loss and UAD. Loss for another 8 years, another 8 years, another 8 years. Another 8 years you will get the loss, and UAD till infinity. Okay. Now, if you do not comply with any of the conditions, then whatever loss you have set off, it can become deemed income later on. Now, loss means what? Loss means, be careful. Be careful. Loss means only the non-speculation business loss mentioned under section 72. That's it. Loss for the purpose of this section means only non-speculation business loss. None other losses will be covered under this particular section. I hope it is clear to all of you. Is it clear? Now, then I have put the entire PGBP discussion over here. You can go through it once. What is the treatment of amalgamation in scientific research? What is the treatment of amalgamation in your telecom license section? What is the treatment of amalgamation in preliminary expense, amalgamation expense, scientific research expense, VRS expense, mine, bad debts, recovery of bad debts, recovery of expense, depreciation, and how will the assets will be put in the block after you receive from the amalgamating company. Now, you need to pay attention on one thing. Obviously, this is something which I am not going to speak. This you can read at your end, because this is nothing but summing of the entire PGBP provision. Okay. Now, coming to this discussion. Point number 5, 6, 7, 8, 9, 10. What are point number 5, 6, 7, 8, 9, 10? 5 is telecom license, 6, 7, 8, 9, 10. If you observe all of them, 5, 6, 7, 8, 9, 10, one thing is common amongst all of them. And that is all of them talks about an expenditure which amortize over the year. Can you see that? Like preliminary expense, it gets amortized over 5 years. So what will happen in the year of amalgamation? In the year of amalgamation, entire expenditure will be allowed to the amalgamated company. Nothing will be allowed to amalgamating company. In the year of amalgamation, entire will be allowed to amalgamated company. Nothing will be allowed to amalgamating company. Please be very careful. And in future, amalgamated company. In past, amalgamating company was definitely taking, but in the year of amalgamation, no bifurcation, nothing. Entire give it to what? Amalgamated company. I hope it is clear to all of you. Now, the next provision is 43C, not much important for exam, which speaks about if you have received an asset under amalgamation as a capital asset, and later on if you sell that as an SIT, then what will be the cost of that particular asset? Nothing but the cost to the previous owner plus whatever improvement cost is there, add all of them, and that will be considered as your cost of acquisition. Okay. But the thing over here is you are acquiring an asset in amalgamation and you are selling that as what? As an SIT. Then cost to the previous owner is who? Amalgamating company, plus whatever is the cost of improvement on that asset, that will become your actual cost. Okay. Now, there are certain small exemptions which are there in section 47. Let me speak about one by one all of them. That is, if you transfer to government or university or national museum or national art gallery, any of the things like this. That is, if you transfer any work of art, any painting, any drawing, any photography to these people, that is to whom? To government, to university, to national museum, to national art gallery, etc., then it is exempt under the income tax law. Nothing great as such. Okay. Now, 47(7)(c) talks about sovereign gold bonds. Sovereign gold bonds, do you remember? This is one of the bond on which you get indexation. If you transfer as a long-term capital asset, you get indexation on sovereign gold bond and capital index bonds. Do you remember? This is the interlinking I am trying to do with the third proviso to section 48. In section 48 proviso, it was mentioned. Okay. So now, sovereign gold bond, what it has to say? What is the exemption over here? If it is transferred by individual on redemption. So if I am an individual, I buy a sovereign gold bond, and if I transfer on maturity, on redemption, then it is exempt. Otherwise, it is taxable. And if it is taxable, then it is indexation is available. What about others? For others, that is other than individual, only for individual, and on redemption, it is exempt. For in rest of the cases, it is taxable. For others, it means if a company acquires a sovereign gold bonds, then whether it transfers on redemption or before redemption, it doesn't matter. It is taxable in both the cases. I hope it is clear to everyone. It is only exempt to individuals, not to others. Okay. 47(7)(b). This is applicable to certain non-residents. Suppose there is a government security over here. A non-resident has bought that government security which carries a periodic rate of interest. There is a periodic interest which is attached to that government security. So government security is issued to non-resident with a periodic rate of interest, and if this NR sells that security to another NR outside India through a foreign broker, through a foreign intermediary, then this non-resident will not be liable to tax. So NR has to transfer government security to another NR through a foreign broker, and the security should be having a periodic rate of interest. It is exempt under the income tax law, as you can see over here. Next, 47(10) talks about conversion of bonds, debentures, debenture stock or deposit certificate. These are the four things I have mentioned. Conversion of bonds, debentures, debenture certificate and deposits. Deposit certificate and debenture stock. If you convert this into a equity share or into a debenture, if you convert this into an equity share or debenture of that company, then this conversion process is exempt. You can convert a bond into a equity share. This is exempt. What will happen later on? Now you have shares. When you will sell the share, the cost of the shares will be the cost of the debentures or bonds. The period of holding will be clubbed to determine whether the asset is long term or short term. And indexation accordingly, you can apply Manjula Jesha also, or you can take the year in which it is converted. You can do either of the two. The same is the case with applicable for preference shares. If a preference share is converted into what? Equity share, then it is exempt. Conversion of preference shares into equity share is exempt. But later on, when you will sell the equity share, the cost of the equity share will be the cost of the preference shares. The period of holding will be clubbed and all those things will be same only as we have done so far. Okay. When a sick industrial company, sick company transfers land, not all capital asset. When a sick company transfers land, not other capital asset, then it is exempt under the income tax law, as you can see over here. Okay. Next, if a senior citizen transfers his house under the reverse mortgage scheme, then that transfer is exempt under section 4716. So transfer of a capital asset, generally mortgage scheme, reverse mortgage scheme is applicable to senior citizens. It is not written in the law, but it is applicable in practical life to senior citizens only. So if I transfer a reverse mortgage, if I transfer a capital asset under the reverse mortgage scheme, then it is exempt in the hands of the transferor. In return, what I will get? In return, I will get some money in lump sum or in installment. Whatever money in lump sum or in installment I am getting, that will also be exempt under section 1043, as you can see over here. Okay. Then 4718 and 4719 has to be read together. 18 talks about consolidation of mutual fund schemes. And 19 talks about consolidation of mutual fund plans. Mutual fund has lot of schemes. In every scheme, there are a lot of plans. Like different plans are there. Plans is the lowest part of mutual fund. Schemes is the middle part of mutual fund and at the top is the mutual fund company. So if there are consolidation of one or more schemes or one or more plan with another plan, then the units have to be exchanged. Suppose there are two schemes, Reliance FMCG scheme and Reliance Blue Chip scheme. And FMCG is getting merged with Blue Chip. So this is known as consolidation. So the entity which is getting merged is called as consolidating entity and it is merged with that entity is called as consolidated entity. So whatever units I have of FMCG, that I have to return back to the company and the company will allot me the units from the Reliance FMCG. So if I return the units of, it is just like amalgamation. If I return the units of amalgamating company, that is consolidating scheme, and take the units of consolidated scheme, then it is exempt. Later on, whenever I will sell the units of the consolidated scheme, the cost of acquisition of this scheme will be that scheme. Period of holding will be clubbed. It is exactly same. You can check over here. So let's go ahead with the next one. It's an important one. If a rupee denominated bond of an Indian company is allowed to issue a rupee denominated bond, and if a rupee denominated bond of Indian company is transferred by one NR to another NR, NR has to transfer to NR only outside India, then it is exempt. So NR, if transfers to NR, then it is exempt. It means if the NR gives back the bond to company and takes the money from company on redemption, then it is taxable. So at the time of redemption, if there is any gain which is coming because of foreign exchange, only because of currency exchange, if any gain is coming, because rupee might depreciate in future, and if rupee depreciate in future, the gain will be there because of the currency gain, then that gain will be exempt under 5th proviso to section 48. This is something which we have left earlier under section 48. You can go and check. I have told you we will be looking at later on. Okay. So if a rupee denominated bond is returned by an investor to company on redemption, then this exemption is not available, because this is available when NR transfers to NR. So if this is transferred to company back and the company gives the money and there is a gain to the investor because of the depreciation of rupee, sorry, appreciation of rupee, not depreciation. Because of depreciation, there will be a loss. Because of appreciation, there will be a profit. So that profit because of appreciation which is happening, that is exempt. Okay. Now, coming to certain provisions which are applicable to non-residents. Okay. So, this provision which is applicable to 47(7)(ab), which is applicable exclusively to the non-resident. Listen carefully. There is a non-resident, okay, who is transferring these assets. Okay. So, the following transactions will be exempt in the hands of the non-resident. Okay. When it is exempt? When he is transferring these assets through a recognized stock exchange located in IFSC. He should transfer these assets through a recognized stock exchange located in IFSC. Now, which are these assets? These are bonds or GDR as referred to in 115 AC, which you will do in NR. These are rupee denominated bond of Indian company or derivative or such other security as may be notified by central government. Which are other security, which you can see over here. First is foreign currency denominated bond is the security which the government has notified. Second is unit of mutual fund or business trust or alternative investment fund AIF. Third is foreign currency denominated equity shares of a company which are listed on a recognized stock exchange in IFSC. So if an NR transfers these assets in a listed stock exchange, in a recognized stock exchange in IFSC which is located in Gujarat, then only these things are exempt, otherwise these things are not exempt. Okay, coming to section 10(4)(d), the following incomes received by specified fund would be exempt. So first thing which we need to understand, who are specified fund. Specified fund includes two things, two people. One is this and another is this. Another one, the second one is added by Finance Act 2021. The first one is there since very beginning, okay, since the section came. So the first specified fund is this, a fund which is established in India in the form of a company, LLP or trust. It should be in the form of company, LLP or trust, which has been granted a registration of AIF, Alternative Investment Fund Category 3. So it has been registered like an AIF. That fund is registered like an AIF and that should be located in IFSC, and all its units are held by non-residents other than the units held by sponsor or managers. If the sponsor of that particular fund is a resident, that is fine. If the manager, sponsor means the promoter, manager means the person who is managing the fund. So if the sponsor and the manager are residents, that is fine. Apart from that, all of them have to be non-resident, that's it. So if these conditions are fulfilled, the assessee would be called as specified fund. Second specified fund is what? Investment division of an offshore banking unit. What is an investment division of an offshore banking unit? That is the definition which is given over here. It means a non-resident bank. It is a non-resident bank who has an investment division. Every bank has an investment division to invest their money. So a non-resident, say Standard Chartered, having an investment division in IFSC, that will be called as investment division of offshore banking unit. Non-resident plus banking company plus in IFSC, that will be called as investment division of offshore banking unit. That should be categorized as a category 1 FPI, foreign portfolio investor, and it should fulfill such other condition as may be fulfilled. If you fulfill these conditions, then these incomes are exempt. First, any income from transfer of capital asset is exempt, which are mentioned in 47(7)(ab). What is 47(7)(ab)? The above point. If you transfer these assets, these all are mentioned in 47(7)(ab), right? If you transfer these assets, then this is exempt. What income is recognized out of transfer of asset? The income which is recognized out of transfer of asset is capital gain. Obviously, when you transfer a capital asset, there will be capital gains, right? Second, any income from transfer of securities other than the shares of Indian resident company. Okay. So any securities if you transfer, who will transfer? Specified fund will transfer. Who is specified fund? Either a trust, LLP, etc., or second one is investment division of offshore banking unit. Either of the two can become specified fund. If they transfer what? Securities, they will be exempt under 10(4)(d). But if they transfer shares of resident company in India, then that will not be exempt because that is excluded from this particular point. Third one is not, this is also a capital gains transfer because there also the government is using the word transfer. Therefore, this income will also be a capital gains income. Third, income from securities. Now this is income from security. So this will be either dividend or interest because this is not telling income from transfer of security. This is saying income from security. It means it can be in the form of a recurring income, in the form of dividend, or in the form of interest. Income from securities issued by non-resident, not being a PE of a non-resident in India. So the non-resident has to be that non-resident which is outside India. It should not have a PE in India. And last but not least, again, income from securitization trust, which we have done one topic of securitization where I have explained you how the banks sells the data to securitization trust and securitization trust gives the money outrightly to the bank, so on and so forth. So if you are earning some income from what? Securitization trust, then all these incomes are exempt to the extent are exempt under the income tax law to the extent the units are held by non-resident. So if they have 100 rupees, they have 100 rupees income and their non-resident unit holders are only 90%. So 90% will be exempt, 10% will be taxable. So income will be exempt. If they want to make their income exempt, then 100% of the unit holders has to be non-resident. Otherwise, it will be taxable to proportionate extent. Next. Again, it's a very new amendment. Transfer of relocation of a capital asset. Transfer in relocation of a capital asset by original fund to resulting fund. Let me give you a brief funda of this. There is one original fund which is outside India. There is one resulting fund which is in India. And there are unit holders of original fund outside India. There are unit holders of resulting fund in India. Now, if that fund is getting transferred to India, original fund which is there outside India, it is getting transferred to India, then the capital gains will be exempt over here. Okay. Whatever transfer of capital asset will be done by original fund to resulting fund which is outside to India, original fund is outside or original or outside and resulting fund is in India. So original fund is transferring assets to resulting fund, capital asset is transferred. The unit holders are also transferring their interest from original fund to means they will sacrifice their units in the original fund, and in return they will take the units in the resulting fund, then that is also exempt under income tax law. You will get the definition of original fund over here. It is a fund which is not a resident in India. It is established outside India. It is a resident of a country with which India has DTAA. India need to have a DTAA with that particular country, and it is a fund of that country where there is a law like SEBI. In India, SEBI is protecting the regulation, protecting the rights of the investors. In the same way, the fund should be protected by some or the other law in the respective country. So the fund should be established. Original fund should be outside India. It should be not a resident of India. It should be a resident of that country with which India has a DTAA, and there in that country there has to be some authority like SEBI. Who is the resulting fund? Resulting fund is mentioned over here. Resulting fund is obviously established in India. In India, as I have told you, original fund to resulting fund, from outside India to in India, you have to transfer the asset, you have to transfer the shareholders, everything will be exempt over here. And the resulting fund has to be located again in IFSC. Resulting fund cannot be located at any other place. If it is located in Mumbai or Delhi or Chennai or Tamil Nadu, or for example Kerala, Thiruvananthapuram, Coimbatore or Bangalore or Mysore, then it will not be subject to exemption. The resulting fund has to be located in what? IFSC, that is in Gujarat. Then only it is an exempt income. Okay. Next. Last two small benefits over here, 47(7)(e). Any transfer of capital asset by a special entity, by India Infrastructure Finance Company to an institution set up for financing the infrastructure, then that is exempt. So there is an infrastructure setup company, infrastructure finance company, which is transferring asset. So who is the transferor? India Infrastructure Finance Company. Who is the transferee? An institution set up for financing infrastructure and development in India by the central government. So this is the transferor, this is the transferee, a very small amendment made by Finance Act 2021, then this is also exempt. Next. Any transfer of capital asset by a public sector company to a notified public sector company or to central government or state government. So if a public sector company is transferring asset to another public sector company or to central or state government, then that is also exempt under the income tax law. I hope it is clear to all of you. Now let's go ahead with the next one. That is a conversion of a firm into a company, or a conversion of a sole proprietor into a company. So when a firm is converted into a company, then all the capital assets which are transferred from firm to company are exempt if four conditions are fulfilled. First, all the assets and liabilities of the firm shall be transferred to the company. All, nothing should be left. Everything should be transferred. Second, all the partners of the firm shall become the shareholders of the company in the ratio in which their capital account stood, not in the ratio of PSR, but in the ratio in which the capital account stood. Third, the partner should not receive anything except shares. They should not receive any consideration except shares from the company. Fourth, the aggregate shareholding of all the partners in the company should not be less than 50%, and that should be maintained for a period of 5 years. It should be maintained for a period of 5 years from the year of conversion. Okay. Similarly, for sole proprietor, all the conditions are same except the second one, which is not applicable for sole proprietor. Sole proprietor will have to fulfill first, third, and fourth one. Okay, the second one is irrelevant for them. You can check it. Okay. Now, similarly, for these two assessees, capital gains are exempt. Similarly, in this case also, the firm or sole proprietor, whatever the business loss is there under section 72 and UAD is there under section 32 subsection 2, will be transferred to the company for another 8 years, just like amalgamation. 72A is applicable here also. Now, in future, if you violate any condition, then this exemption which is given will be withdrawn over here under section 47A, and it will be deemed to be income in the hands of the assessee. Okay. Now, a few small points which I would like to tell you. First of all, this section is applicable to business. It is not applicable to professions. If a profession is succeeded, then it will be subject to tax. It is not exempt under this section. This section is only applicable to a business. First thing. Okay. Can the partner be minor? Yes, the partner can minor also. Minor partner can be included in the partnership firm. There is nothing wrong in that. Similarly, this point is not relevant. Actually, this is wrong. I'm sorry for that. This case law is not relevant now. Business profits are not exempt. What is the exempt is only the capital profits. That is capital gains. Business profit is not exempt. Suppose if some of the partners have negative capital, then what to do? If some of the partners have negative capital, then in that case, you have to make the partner's capital positive first of all. Then only this conversion is possible. Otherwise, this conversion will become what? Taxable. So that's it. This is the small section which is there under section 4713 and 4714. Now let's go ahead with the next one, and that is a very important section, that is 4713B, which says that when you convert a private company or an unlisted company into an LLP, then whatever capital assets are transferred from here to there are exempt under income tax law, and even whatever the shareholders will give the shares back, because when a company is converted into an LLP, the shareholders have to give their shares back to the company, and in return they will get what? They will get share of profit in the LLP. So that transfer in the hands of shareholder is also exempt under section 4713B. subject to 7 conditions which needs to be fulfilled. First, all the assets and liabilities of the company, that is unlisted company and private company, I will not say again and again this, I will say company. All the assets and liabilities of the company has to be transferred to the what? To the LLP. Second, all the shareholders of the LLP shall become the partner in the firm, that is in the LLP, and the ratio should be the same. The capital contribution ratio and the profit sharing ratio, everything should be same as what? As the shareholding ratio. So whatever is the shareholding ratio, that ratio will be the ratio of capital contribution and PSR. Okay. The shareholder does not receive anything apart from the share of profit in the firm. They should not receive anything apart from that. Fourth, the aggregate shareholding of all the partners, of all the shareholders, the aggregate partnership of all the shareholders in the LLP should not be less than 50% of the total profits. And it should be maintained for a period of 5 years from the date of succession or conversion, whatever you want to say. Fifth condition, the turnover of the company should not be more than 60 lakhs in any of the last 3 years. In any of the last 3 years, it should not be more than 60 lakh rupees. Sixth, the book value of the asset should not exceed 5 crore rupees in any of the last 3 years. At any time during the last 3 years, the book value of the asset should not exceed 5 crore rupees. Next, and the last one, the company would have some P&L account. That P&L account would have some profits. That profit would have been transferred to all the partners' capital account. Now, the partners cannot withdraw that profit for a period of 3 years. So, the profit which has come from company to the LLP, that profit should not be withdrawn for a period of 3 years by the partnership firm. I hope it is clear to all of you till here. Okay. Now, if these conditions are fulfilled, as I have told you, all the assets which are transferred are exempt, and the shareholders who are forgiving their shares, in return, they are taking what? In return, they are taking the share of profit in the LLP, that will also be exempt. Okay. If any of the conditions mentioned over here are violated, then the capital gains which is exempt will become deemed income later on. Okay. Now, can the company transfer the MAT credit to the LLP? The answer is no. The MAT credit cannot be transferred to the LLP. Can the company transfer UAD to the LLP? Yes, UAD can be transferred. 72A is applicable here also. Can the company transfer business loss to the LLP? Yes, only business loss mentioned in section 72 can be transferred from the company to the LLP as per 72, as you can see over here. I hope it is clear to all of you. Rest all are same. Later on, if the company sells the asset, then what will be the cost of acquisition in the hands of the company? It will be the cost to the previous owner. The period of holding will be clubbed, etc., etc., etc. Okay. Now, let's move on to the next one, that is conversion of a stock exchange into a company. Suppose there is a stock exchange. Initially, it was an AOP BOI. Generally, the stock exchange at the beginning of its life is generally an AOP BOI, and the members of that stock exchange purchase membership card in that particular AOP BOI to trade in stock market. Okay. So, there is a stock exchange which is in the form of AOP BOI, and there is a member who has purchased the membership card. Now, if this AOP BOI, that is stock exchange, wishes to convert into a corporate, that is a company, as you all should know, now the BSC is a company. It's a listed company in stock market. So, if this stock exchange is converting into a company, then what are the tax implications? First, whatever assets are transferred by the AOP BOI, being the stock exchange, to the BSC Limited, being the company, will be exempt subject to 2 conditions. First, all the assets and liabilities are transferred over here. Second, this conversion is as per SEBI regulation. If this conversion is happening of an AOP BOI into a company of a stock exchange is as per SEBI regulation, then it is exempt. Otherwise, it will be taxable. Second, the member holds a membership card. So, he has to give back the membership card. So, if he gives back the membership card and in return, if he takes 2 things. First, equity shares in the company and trading and clearing rights, then that particular transfer in the hands of member is exempt under income tax law. Now, after the conversion, the member holds 2 things now. One, he has the equity share, another he has trading and clearing rights. Later on, if he sells these 2, what will be the cost of acquisition? The period of holding will be clubbed. And what will be the cost of acquisition? The cost of acquisition of the equity share will be same as the cost of the membership card purchased by the member in the AOP. And the cost of acquisition of the trading and clearing rights which he has got in the company will be nil as per section 55. I hope everybody is clear. Plus, here you do not get the option to take FMV as on 1/4/2001. The option to take FMV as on if the membership card is purchased prior to 1/4/2001, then generally we take FMV as on 1/4/2001 or actual cost, whichever is higher, whichever is more beneficial to the assessee. But in this case, you are not allowed to take what? The FMV as on 1/4/2001, just like in case of goodwill of a business or profession, patent, copyright, in case of, say, for example, right to manufacture. If you remember those lists which we have done in the first chapter, there also I have written there are 2 places where you cannot take FMV as on 1/4/2001. One was that, and the second was this I was talking about. Last but not least, whatever AOP has depreciable asset, that will also be transferred to the new company. So, what will be the WDV in the hands of the new company? Nothing. Whatever was WDV in the hands of the old AOP, will become WDV in the hands of the new company as per explanation 12 to section 43.1, and you can see over here. Next is a concept of income disclosure scheme 2016. You might be knowing there was some income disclosure scheme which came in 2015 and which came on 1st June 2016 and which allowed, it was not 2015, sorry, it was 2016, and which allowed the assessee to declare their assets from 1st June 2016 to 30th September 2016. Now, if you have declared some asset, then you have to pay 45% tax on that, as you can see over there. Suppose if I declare an immovable property of say 10 crore rupees, which I have not disclosed earlier, and I have disclosed that in income disclosure scheme, I have to pay 45% tax on that particular asset. Or if I have disclosed some jewelry, or if I disclose some any other asset, you have to pay 45% tax. The breakup of the tax you can see over here: 30% income tax and 25% of Krishi Kalyan cess and penalty. Both will be 25%. Okay, so total will come to 45% tax. So suppose I have declared the asset. Now the asset has become white. It has become a white property now. So later on, if I sell the asset, what will be the cost of acquisition and what will be the period of holding? So that is something which we are trying to understand. What will be the cost of acquisition? The cost of acquisition is defined under section 49.5. Whatever you have declared as a value, whatever is the amount on which you have paid tax over here, that will become the cost of acquisition later on. Is it clear? So the cost of acquisition will be the FMV which you have declared for the purpose of tax. That will become the cost of acquisition later on. But the question is, what will be the period of holding? From when am I supposed to consider the period of holding? Suppose if I sell that asset in 2021-22. So from when I'm supposed to take the period of holding? So in this case, in case of immovable property, if you have a proof of purchase, you can take from the date of purchase. And in case of any other case, you have to take from 1st June. This will also include immovable property if proof of purchase is not there. And this will include other assets as well, all other assets in this world. Only if there is an immovable property and you have a proof of purchase that you have purchased in 2012, 2010, 2009, 2008, you will count the period of holding from there. If you do not have a proof of purchase, and in case of all other assets, apart from immovable property, everything will come over here. And immovable property can also come over here. That is from 1st June 2016, you have to compute the period of holding. I hope it is clear to all of you. Okay, let's move on to the next topic. That is forfeiture of advance. Now, if you have purchased some capital asset, now if you wish to sell that capital asset to someone, now you have taken some advance from that other person, and that other person is not making the balance payment to you. So you forfeit that advance. So whatever advance you have forfeited, what will be the treatment of that? Listen carefully. There are two treatment possible. First, if the advance is forfeited before 1st April 2014, if it is forfeited before 1st April 2014, then it will be reduced from your cost of acquisition whenever you will sell that asset as per section 51. So if it is before 1/4/2014, then you have to reduce it from the cost of acquisition whenever you will sell that asset. But if it is forfeited on or after 1/4/2014, then you don't have to make any deduction. It will directly become an IFOS under section 56. It will be directly an IFOS income. This is what it is written over here. Okay. Then there is one small case law over here. Let me address that particular case law over here. That I have purchased, I am a seller, you are a buyer. We both have entered into an agreement whereby I have committed that I will sell you asset and you have committed that you will buy assets from me only. So we both are under a commitment that I will sell you and you will buy from me. For that, you have given me a token money of 40,000 rupees. Now, whatever token money you have given me 40,000 rupees, that is just to make sure that I do not sell to any other person. Now, after a few years, you are standing on your promise, but I am not standing on my promise. I am going against my promise and I am telling you, I am seller, I am telling you, I don't want to sell you. So the buyer is agreeing. The buyer said that pay me compensation. You have told me that you will sell me. That's the reason I have not searched for other properties. So I gave him a compensation of 6 lakh rupees. Whether that 6 lakh rupees will be chargeable in the hands of the buyer, the answer is yes. The reason being, because buyer has relinquished his right of purchasing the asset from me. For that, he is getting what? 6 lakh rupees, and therefore the buyer will be chargeable to capital gain tax. Is it clear, all of you? Now let's move on to the next topic, that is certain exemptions under section 10 and then 111A and 112A. Okay, the first thing is if you transfer a unit scheme, unit of a unit scheme, then it is exempt under section 1033. If you transfer a unit of a unit scheme, then it is exempt under section 1033. Okay, 1037. What is this section all about? If the assessee is individual and HUF, and if the assessee has transferred agricultural land, which is an urban agricultural land, anyways, rural agricultural land is exempt. It is not a capital asset only. Therefore, if the assessee is individual HUF and transfers an urban agricultural land which was used by assessee himself or his parents for at least 2 years for agriculture purpose, and it is compulsorily acquired by the government, it is not sold by the assessee. If it is sold by the assessee, then it is not exempt. If it is compulsorily acquired by the government, then it is exempt. Then the original compensation as well as the enhanced compensation both will be exempt under section 1037. However, if the same asset where assessee is individual HUF, urban agricultural land at least used for 2 years by assessee or his parents for agricultural purpose, and if it is not compulsorily acquired but it is sold by the assessee, then the capital gains can become exempt under section 54B subject to conditions mentioned over there. This is the interlinking I have tried to do over here. Okay. Next one is for the new capital city of Andhra Pradesh, that is Amaravati. We all know that Andhra Pradesh and Telangana got split in 2014, and after that Andhra Pradesh is willing to make its own capital, and for that the Andhra Pradesh state government has brought a concept of land acquisition scheme. For that purpose, if any person transfers certain land, certain certificates, then that is exempt under section 1037A. First of all, this section is applicable for whom? This section is applicable to an individual HUF and who owns a land or building or both on 2nd June 2014. This is the date on which Telangana was formed and Andhra Pradesh was formed. This is the date on which, this is the birth of Andhra Pradesh and Telangana, that is separation of Andhra Pradesh and Telangana. Now in this case, what has happened? If I am a resident of Andhra Pradesh and if I transfer a land under the land acquisition scheme, land pooling scheme, and in return the government gives me a land pooling ownership certificate, then that is exempt under section 1037A. Then later on, now I have given land and in return the government has given, first transaction I gave land or building or both and they gave me a land pooling ownership certificate, that is exempt in my hands. Second, now I have land pooling ownership certificate. Now if I transfer this land pooling ownership certificate, then that is exempt under income tax law in point number 2. Third is I have a land pooling ownership certificate. I have given back that to the government and government has given me a reconstituted plot of land in the new capital city Amaravati. So in that case, if I transfer that new land also within 2 years from the end of the financial year in which the land was possessed by me, in which I have got the possession of the land. So whenever I will get the new land in that year, from the end of that year, suppose if I get the new land in March 24, so from the end of March 24, that is 2 years, that is 31st March 2026. If I sell that land, then that is also exempt under income tax law. It means if I sell after 2 years, then it will become what? It will become taxable under the income tax law. So if I sell after 2 years, then what will be the cost of acquisition of that land? The cost of acquisition of that land will be the stamp duty value when 2 years expire. So in my case, if the land was given as a possession in 24 March, then I have to transfer it before 26 March. If I transfer before 26 March, that is March 2026, then it is exempt. If I transfer after March 2026, then it is taxable and the cost of acquisition will be stamp duty value of that reconstituted plot of land on 31st March 2026. That is when 2 years expire. That is what it is written over here under the income tax law. Now let's move on to a very important section, that is 112A, which is applicable to long-term capital assets, certain capital assets which are long-term. First is equity shares, second is equity oriented mutual fund, which will also include the ULIP, to which the 4th and the 5th proviso does not apply. It means that ULIP, we have already done this discussion, that ULIP whose annual premium is more than 2,50,000 rupees and that ULIP which is issued on or after 1st Feb 2021, that ULIP will also be subject to 112A. Third is units of business trust. So these three things, if it is long term in nature, it will be subject to tax. Okay, over here, what is the tax benefit over here? The tax benefit over here is you will be liable for 10% tax under 112A with an exemption of 1 lakh rupees flat to all kind of assessees. Every assessee will get 1 lakh rupees flat exemption. Now you have to fulfill certain conditions to come over here. The first condition is the asset should be long term. Second condition, in case of equity shares, the STT should have been paid both at the time of purchase and at the time of sale. In case of equity share, the STT has to be paid both at the time of purchase and both at the time of sale. There are some exceptions where you have not paid STT on purchase, then it is fine. First exception is if you have purchased the equity share before 1st October 2004 and you have not paid the STT, then it is fine. In that case, even if you have paid STT only on sale, you will be liable for, you will be eligible for this particular exemption. Second case is the government has made certain notification in which if you acquire in that form, the way it is mentioned in the notification, if you acquire in that form, then in that case also you may not have paid the STT on purchase, then it is allowed. By default, in case of equity share, you have to pay STT on purchase as well as on sale. But there are two exceptions where you have not paid STT on purchase, then it is fine. First, if you have purchased before 1/4/2000, 1/10/2004, 1st October 2004, then STT, even if you have not paid, it is fine, because before 1/10/2004, STT was not chargeable only. If it was not chargeable only, how the hell I will pay that? Second, government has given certain exceptions list in the notification in which if you buy in that form, then on purchase, even if you have not paid the STT, you will be eligible for this particular section. Then for equity oriented fund, ULIP and units of business trust, there is only one condition, that you have to pay STT on sale. Payment of STT on purchase is not mandatory. If you have paid, well and good. Even if you have not paid on purchase, it's all fine. You have to pay only on sale. Then coming to the IFSC point. In IFSC, if there is a stock exchange, STT is not chargeable only in that particular stock exchange. IFSC, which is located in Gujarat, GIFT City, In that, STT is not chargeable only. If STT is not chargeable only, then I will not get the benefit of this section. But the government has given a benefit over here for IFSC people and said that if you are transacting a transaction, if you are purchasing or selling a transaction stocks through IFSC recognized stock exchange, and if you have not paid the STT, still you can take the benefit of this particular section. Okay. Now, the benefit is what? 1 lakh rupees exemption you will get, and on balance amount you will be liable for payment of tax of 10%. Okay. Will I get the benefit of 2,50,000 rupees, 3 lakh and 5 lakh? Generally, the benefit of exhausting the basic exemption limit, the answer is yes, only to residents. To resident, individual and HUF, you will get the benefit of 2,50,000, 3 lakh, 5 lakh, and along with that, you will also get the benefit of 1 lakh rupees. This benefit is also there in 111A and 112. This benefit is there in 112A, 111A, 112, but only for residents and not for non-residents. If you are a non-resident, you will get 1 lakh. 1 lakh is across all the assessees, but the basic exemption limit will not be allowed to non-residents. Okay. Now, what if I have purchased the shares before the announcement of this section, that is grandfathering provision? When was this provision announced? This provision was announced on 1st of Feb 2018. Before that, everything was exempt. All these capital gains were exempt. But from 1st of April 2018, that it will be taxable, and it was announced on 1st Feb 2018. Within 31st March, 31st Jan 2018, nobody was knowing that something will come tomorrow like this. And on 1st of Feb 2018, the government announced that. So if you have purchased the equity share or equity oriented fund or units of business trust before 1st Feb 2018, then how will you determine the cost of acquisition? There is a special way to determine the cost of acquisition as per section 55 subsection 2 clause AC. Step 1, you have to determine your actual cost. Suppose actual cost is 100 rupees. Then step 2, you have to determine the FMV of the shares on 31st Jan. Suppose FMV of the share is 1500 rupees. And then step 2, within step 2, there is second part. You have to determine the sale consideration. Suppose the sale consideration is 2500. Then this and this, whichever is less. Whichever is less will come to how much? 1500. And then this and this, whichever is higher, will become your cost. And therefore, eventually your cost will become how much? 1500. So step 1 is your cost. Step 2 is a comparison of two things, whichever is less. FMV on 31st Jan 2018 compared with sale consideration, whichever is less. Compare that with step number 1, and then whichever is higher will become your cost of acquisition. Okay. Now the question will arise, how will I determine the FMV as on 31st Jan 2018? So you have to find out different ways. First of all, in case of quoted shares, quoted means listed shares and listed units, the FMV will be determined on 31st Jan based on the highest price on that particular date. Don't take any average, etc. Take highest price of the share or unit on that particular day in the recognized stock exchange. If on that day trading has not happened, then take the previous day, take 30th Jan, 29th Jan, 28th Jan, 27th Jan, whichever day trading has happened. Okay. Now, this covers what? Point number 1 covers listed shares and listed units both. Point number 2 covers what? Unlisted units. You list units which are not listed on 31st Jan 2018. Then take the NAV of that particular unit. Whatever is the NAV, net asset value of that unit on 31st Jan, you have to take that as your value. Okay. Third one. Suppose the shares which are not listed, this covers only units which are not listed, this covers both listed. What about if the shares which are not listed on 31st Jan and later on it became listed? So in that case, how will it determine the cost of acquisition? Suppose I purchased the unlisted shares in 2010 and in 2018 it was again unlisted, and in 2022 when I am selling the shares, it become listed, STT is chargeable. So in that case, how will I determine the cost of acquisition? In that case, the government has given a unique way of increasing the cost. The government says that whatever is the cost of acquisition, take that, multiply by cost inflation index of 2017-18 when this provision came. This provision came in 2017-18. Multiply by that cost inflation index and then divide by what? Divided by the year or in which you have purchased the asset, and if you have purchased before 2001, then take the cost inflation index as 100 as the case may be. So you have to inflate this cost inflation index to what? To 2017-18. And after that, that will become your cost of acquisition. Reduced from sale consideration, you will get your what? You will get your capital gains. Next, there are a few points to be kept in mind over here. An assessee who is covered by 112A, indexation benefit is not available for that assessee. An assessee who is covered by section 112A, first provision to 48 is not applicable. It means all those nakra of TTBR, TTSR need not be done by the assessee. An assessee who is covered by 112A, 112A capital gains is not subject to deductions under ATC to ATU. Deductions under ATC to ATU is not available to 112A assessees. And the fourth condition, 87A rebate is also not available to 112A assessee. All these points are negative points, negative points, negative points. 87A rebate is also not available. It means if you are earning only long-term capital gains under this section, say of 4 lakh rupees, you will get an exemption of 1 lakh. 1 lakh is across all stream. But you will not get rebate under 87A because your total income is lesser than what? 5 lakh rupees. Rebate is not available for this particular capital gains. Last but not least, if you are incurring some loss under this section, then that loss can be carried forward and set off like a normal loss under section 74. That is something which is allowed because the income is also taxable. The loss can also be carried forward. Let us talk about STCG now. STCG 111A, the same asset, that is equity shares, equity oriented mutual fund, units of business trust. If these are short term, then it will be chargeable at 15%. Here you are not going to get any exemption of 1 lakh, etc. Directly 15%. Okay, directly 15%. Then whether STT is supposed to be paid only on sale, on everything, on shares also, on units also, on everything. There is no need to pay STT on purchase. Only STT on sale is required. STT on purchase is not required. That's it. There's nothing great after, apart from this. Last but not least, whether when I sell some shares or securities and earn some profits and gains, where it has to be charged. The CBDT has said that it all depends upon the facts and circumstances of every case. Sometimes it might be charged under the head PGBP, sometimes it might be charged under the head capital gains. If you are holding that asset in the form of a stock and trade, then PGBP. If you are holding that asset in the form of a capital asset, then investment. If you are frequently selling, then PGBP. If you are holding for more than 12 months, then it is capital gains. There is no one thumb rule to identify when capital gains and when PGBP. Okay. Now let's move on to the next one, and that is exemption under section 54. And in all, there are 8 exemptions under section 54, from 54 to section 54 GB. I'll be speaking about the first one first of all, and rest of them will follow that. Rest of them will have some minor changes in that, and most of them will follow that. Okay, the first one I'm speaking about. In the first one, you are transferring a residential house property, you are transferring a long-term residential house property, and there is a long-term capital gain to you. And you have to purchase another residential house property only. In section 54, you have to transfer a long-term residential house property and you have to purchase or construct a new residential house property. Okay. Now, by when I am supposed to construct or purchase? You can purchase 1 year before. Suppose if I transfer today and if you have purchased in last 1 year, then it is fine. Or you can purchase in the next 2 years, then also it is fine. Or you can complete the construction within the next 3 years. Okay. So, date of transfer is the cutoff date. From this date, you can purchase 1 year before or purchase 2 years after or construct within 3 years from the date of what? Sale, date of transfer. Will I get an option to deposit the amount in a deposit scheme? Yes. For that, we have made a note over here, which note is common for all section except 54EC. For 54EC, deposit scheme is not available. The best thing is you have to acquire a new asset, a new residential house property or whatever asset in different sections by the due date of filing of return. But in case you are not able to acquire by the due date of filing of return, then in that case, you can deposit that money in the capital gain account scheme, but on or before the time. If you deposit on time, then you will get the exemption today. But if you do not deposit on time, you will not get the exemption. So the best thing is what? You purchase the asset in the same year itself. Till the due date of filing of return, you purchase it. If you are not able to purchase it within the time mentioned in the due date of filing of return, then at least deposit that money in CGS. And then in future, withdraw that money and purchase or construct. And if you do not construct or purchase till 3 years, then that amount, that unutilized portion in the capital gain account scheme will become your deemed income. In the meanwhile, sir, if I am dead and if my legal heir withdraws that money, then if I am dead, the assessee is dead and the legal heir withdraws the money, then CBDT has said that it will be exempt in the hands of legal heir, as you can see over there. There is a CBDT circular over here. In all the cases, you have to withdraw the money and use within 3 years. But in section 54B, the time limit is only 2 years. It is not 3 years. Okay. Please be attention. Please pay attention on that. Next, how much exemption I will get? There are 2 categories of sections in which you get exemption. In some categories, that is in 54F and GB, the treatment is different. And in all other sections except 54GB and F, the treatment is different. So what is the treatment in most of the sections? And what is the treatment in these 2 sections? What is the treatment in most of the sections? In most of the section, whatever gain will come to you, suppose the gain is say full value of consideration is say 1 crore and your cost of acquisition is 40 lakhs, so your gain is 60 lakhs. So in most of the sections, you have to invest your gain. You invest 60 lakhs or the amount invested, whichever is lower, will be allowed as deduction. So you have to invest the gain in most of the sections. But in 54F and 54GB, you are not supposed to invest gain. You are supposed to invest the net consideration over here. A higher amount has to be invested. So in these sections, the above 6 to 5 to 6 section, you have to invest what? You have to invest the gain. Investment will be sufficient to make your capital gains exempt. But here, gain investment is not sufficient. Here, you have to invest the net consideration. If you invest the entire net consideration, then the entire gain would be exempted. If you invest lesser than the net consideration, then your proportionate capital gain will be exempted as it is mentioned over here. Whatever is the capital gains, multiply by the cost of new asset divided by the net sale consideration. Cost of new asset is the amount which you have invested in the new asset. So please keep this thing in your mind. Okay. Next, is there any lock-in period once you buy a new asset? The answer is yes. The lock-in is 5 years for you. 3 years for you in most of the cases. In 54EC, it is what? It is 5 years. In maximum section, the lock-in is 3 years. In 54EC, it is 5 years. So what if I sell the assets within the lock-in period? There also there are 2 treatments. In series of these sections, the treatment is different, and in series of this section, the treatment is different. How it is different? Listen carefully. Whatever new asset I have bought, I have to keep it with me for a period of 3 years at least. Okay. If I sell within 3 years, okay, then what will happen as per these sections? As per these sections, first of all, you will write the sale consideration of the new asset minus expense on transfer on the new asset, and then you will do what? You will adjust here the cost of acquisition. How? the cost of acquisition of the new asset minus the exemption taken earlier, because you are violating your promises, because you are selling the asset within 3 years, so you are violating your promise. So whatever exemption was taken earlier has to be reduced from the cost of acquisition, and you have to put here a reduced cost of acquisition and then cost of improvement and capital gains. But in these three sections, it is not like that. In these three sections, what happens? You'll put the sale consideration of the new asset, expense on transfer of new asset, net sale consideration of new asset. Till here, everything is same. And then you will put only, from here the things change. Here you will put only the full value, full cost of the new asset. You will not adjust the old assets exemption. You will not withdraw the exemption over here. You will add the exemption withdrawn as separately below. I hope you are clear. Now, how to remember that? Please, I'm telling you a hint. A hint is written over here. If you are buying asset and your selling asset is same, if what you are selling and what you are going to buy is same, then follow this approach, reduce cost approach. And if you are selling asset and your new bought asset is different, then follow this second approach, that is full cost approach. Like example, in 54, what we are learning right now, we are selling a residential property and we are buying a residential property. So both assets are same nature. Then you will follow the first one. As you can see, 54 is covered here. But in 54 EC, you will learn later on. The buying asset is bonds and NHI bonds and RECL bonds, but the selling asset is any long-term asset being land and building. So in this case, the selling asset and the buying asset differs. And so in that case, since both the asset differ, in that case, you will follow this second approach. I hope it is clear to all of you. Okay. Now, coming to this discussion, that is one last thing. Who is eligible for 54? The person who is eligible for 54 is individual and HUF. That's it. All assessees will not get the benefit of this particular section. Now, I have to just do what? Just do comparison of all these sections. That's it. 54B. What are you going to sell? I'm just supposed to tell you what are you going to sell, what are you going to buy, and by when you are going to buy that. That's it. Nothing great has to be seen. This has to be remembered by you all. 54B. I'm going to sell my urban agricultural land, which was used by me or my parents for at least 2 years for agriculture purpose. So sell that. Whatever gain or loss will come, if you want to save that, buy another agricultural land. What you will buy can be rural, urban, both. But what you sell has to be urban. What you sell has to be urban, but what you buy can be rural, urban, both. Why? When am I supposed to buy? You have to buy within 2 years. Within 2 years, you have to purchase. Okay. Then I'm going ahead with the next part. That is, will I get the benefit of deposit in scheme if I'm not able to buy by the due date of filing of return? If you're not able to buy till the due date of filing of return, you can deposit in the scheme and then withdraw and buy within 2 years. Then amount of exemption, you can refer that note. Lock-in period, you can refer that note. And individual and HUF will be available for this particular section, eligible for this section. Next, 54D. What is happening in 54D? In 54D, your industrial land and building, which was used by you for at least 2 years, industrial means business land and building, which was used by you for at least 2 years, is getting compulsorily acquired. You are not selling, but it is getting compulsorily acquired. So whatever gain will come, then whatever gain will come, building will be always short term, because building is a part of block. In case of business, building is always short term. Land may be long term, short term, depending upon the period of holding. So you have to compulsorily acquire land and building and then again purchase land and building at some other place. And you have to do this purchase or construction has to be done within 3 years. Rest all are same except the last point. In the last point, this is available to all assessees, not only individual and HUF. I hope it is clear to all of you. Now coming to this particular section, 54EC, very important. What are you selling in this section? You are selling any long-term capital asset, being land or building. Only if you sell land and building, then this provision is applicable, and that too, it should be long-term, not short-term. And what am I supposed to buy? You are supposed to buy bonds of NHAI, bonds of RECL, or any other notified bond, like Finance Corporation India Limited bonds, or like Indian Railway Finance Corporation Limited bonds. These bonds are also covered here. Then when I am supposed to purchase these bonds? Here the benefit of scheme of scheme of deposit is not available. Here you have to purchase the new bonds within 6 months from the date of transfer. I hope everyone is clear. Plus here the amount of exemption is also different. How it is different? Here you will get maximum exemption of 50 lakhs in a financial year. You cannot get more than 50 lakhs in a financial year in respect of bond. You invest how much ever you want to invest, but you will not get exemption more than 50 lakhs in a financial year. This is also available to all assessee. Here there is a lock-in of 3 years. Here there is a lock-in of 5 years instead of 3 years. So for 5 years you cannot sell these bonds, nor you can hypothecate this bond, mortgage this bond and take loan against this particular thing. All these things are written in the note below. Don't worry about it. Okay. Next is 54F. What am I supposed to sell over here? You sell anything long term except residential property. You sell mutual fund, you sell shares, you sell commercial property, you sell jewelry, you sell diamonds, you sell silver, you sell everything which is long term and then buy a residential house property. You have to purchase 1 year before or 2 years after also you can purchase, or 3 years, within 3 years you can complete the construction. Then you will be eligible for this particular section. You have to sell everything which is long term except residential property and purchase a residential property. This is how it is different from what? This is how it is different from 54, the first section, that is 54. Now, What is the exemption? Scheme of deposit is available? Yes, it is available. Will the amount of exemption will differ over it? Yes. Here you have to invest the net sale consideration and not the gain. In this section and in 54GB, you are supposed to invest the net consideration and not the gain. Then lock-in period is same as 3 years, or individual and HCF is eligible for this particular section. Okay. Next section 54G, which talks about shifting of industry from where to where, from rural area, from urban area to rural area. If you are shifting your industry from urban area to rural area, and if you are selling your land, building, plant and machinery, not furniture, furniture is not covered here. So if you sell your land, building, plant and machinery, and you purchase in rural area land, building, plant and machinery, not furniture, then your capital gains will be exempt, provided you purchase 1 year before or 3 year after, and all the points after that is same as the previous sections. Don't worry about it. Last but not least, it is available to all assessees. Similarly, 54GA, which talks about if you are shifting from urban area to SEZ, here you are shifting to rural area, here you are shifting to SEZ. Nothing is different apart from these two things in both the section. You can check. Is it clear? I hope it is clear to all of you. Okay. Now, certain notes for section 54 and 54F. In both these sections, what you are purchasing or what you are constructing is a residential house. So, in both these sections, the government says that you have to buy one house, not more than one house. You have to buy one house. In 54, you will sell a house and you will buy a house. In 54F, you will sell all other long-term capital asset and you will buy a house, right? So, in both the section, you have to buy one house. So, can I buy an adjacent house and then break a wall and make it one house? Yes. If you buy two houses which are adjacent to each other and you divide that house by breaking that wall, you undivide that house by breaking a wall, by making that house a one single house, then that is allowed. That will be considered. But the houses has to be adjacent and it should be intended to be one single house. Now, one more amendment which was very important amendment which came only for 54. It is not for 54F. It is only for 54. Here the government says that you have one lifetime option. One lifetime option under 54. What is that? Once in a while, once in a life option. That if you are selling a residential house property under 54 and if your long-term capital gains is up to 2 crore rupees, not more than 2 crore, the long-term capital gain is up to 2 crore rupees, then in that case you can buy two residential house properties also. We will give you the benefit of two residential house property. So this is once in a life opportunity. Yes, you have to opt this once in a lifetime. You cannot opt every year, and that too if your long-term capital gains is up to 2 crore. So sir, please give us an example. If I sell my residential house property and the gain is up to 2 crore, can I buy three houses? How? One house which is combination of two houses which is adjacent to each other. Can I consider that as one house and one house somewhere else separately? The answer is yes. You can purchase one Jodi flat. That will be considered as one single house. Jodi flat means which are adjacent to each other. You are breaking the wall. That will be considered as one house, and later on you can purchase another house within the time frame given by the law. That will be considered. So in effect, you are purchasing three houses, but because two are adjacent to each other, those are considered as one single house. It is allowed to you. Okay. Next, can I sell my house and construct my old house? Yes, you can definitely. So I sold one of my house and there was another house of mine. I demolished that and I constructed that. Will I be getting the benefit of exemption? The answer is yes. Now in the section 54 and 54F, it is written that you should complete the construction within 3 years. When should the construction be started then? The construction can be started at any point of time. When should the construction be started? It is not written in the law. When should the construction be completed? That is written in the law. I hope it is clear to all of you. Now, if I have purchased the new house within the time limit, within 2 years or 3 years I have purchased or constructed, but I have not got the registration certificate, I have not registered the property, will I get the exemption? The answer is yes. Registration, title, all of them are irrelevant. Last but not least, if I purchase a house in my wife's name, will it be fine? Yes. Delhi High Court has said in the case of Kamal Wahal that your wife is not a stranger. Till the time you have invested the money out of your pocket, then the exemption will be allowed to you, no matter whether you purchase in the name of wife or in the name of father or in the name of mother or in the name of children. It doesn't matter. Those are not strangers. It is allowed to buy. No worry about it. You have to prove that you have paid for the consideration. In whose name your property is there, it is of no use under the income tax law. 54F, there is a special note which says that for 54F, you need to fulfill one special condition. That is, on the date of sale, you should own only one house, not more than that. On the date of sale, if you want to enjoy. For 54, there is no condition like that. But for 54F, there is a condition. On the date of sale, you should not own more than one house. If you are owning more than one house on the date of sale, then you will not get 54F. You can own either one house or no house. You will get 54F in either of the two cases. Okay. Now, 54EC and 54F, very important issue. In 54EC especially, what you are transferring is long-term capital asset. But long-term capital asset, if it is a part of block, suppose building is a part of block, then in block, the gain is always short-term. Will I get the benefit of 54EC? Suppose I am using a business building and I am selling that business building. I'm using that business building since last 10 years and now I'm selling that. The gain will always be short term because the business is a part of, the building is a part of business because it is a part of block. The gain will always be short term. Will I get the benefit of 54EC? The answer is yes. The law says that, and even the Supreme Court in the case of Ace Builder says that what has to be seen is the nature of capital asset and not the nature of gain. An asset which is a part of block, maybe short term, maybe long term. Gain is always short term. Asset is not always short term. If the asset is held for, that is, if the building is held for more than 24 months, then also the gain is short term, but the asset is long term. In that case, you have to see the nature of asset and not the nature of gain. Because what does 54EC says in the bracket in the Bare Act? The 54EC says in the Bare Act that any gain arising from transfer of long term capital asset. It does not speak about long term capital gains or short term capital gains. It says that the asset has to be long term. The gain can be long term or short term, it doesn't matter, and therefore you will get the benefit of exemption over here. Then this is something which I have told you that for 54EC there is a lock-in of 5 years and you cannot for 5 years hypothecate the bond and take the loan. Okay. Now for 54EC there is a special note which I have put over here. Suppose 3 years back I have converted a capital asset into stock in trade and now I am selling that stock in trade. So I will be liable to tax today, not when I convert it. So from when the 6 months will be counted for the purpose of 54EC? Within 6 months from the date on which I converted, or within 6 months from the date on which I sell the stock in trade? The law says it will be counted from the date within 6 months from the end, within 6 months from the date on which you have sold the stock in trade. I cannot go back and count 6 months from there. 6 months might have been completed in that particular case. Therefore, I have to count 6 months from the date on which I sold the SIT. And one last section over here, that is the big one. And this is the last year for this particular section, that is 54GB. What is 54GB? Who is covered over here? Individual and HUF is covered over here. Resident, non-resident, it doesn't matter. What kind of capital gains are covered over here? You are transferring your long-term residential house property or long-term residential plot of land in India or outside India, and there is a long-term capital gains for you. So if you are transferring a long-term residential house property or a long-term residential plot of land and there is a long-term capital gains, you can get exempt over here in this particular section. What am I supposed to do? You have to purchase the equity shares of the eligible company on or before the due date of filing of return. You have to purchase only the equity shares and not the preference shares. You have to purchase. First of all, you are individual HUF. You are transferring your long-term residential house property or residential plot of land. There is a gain which is arising to you, long-term capital gains. So if you want to make it exempt, invest into the shares of the equity shares of the eligible company on or before the due date of filing of return. What eligible company is? Eligible company means a company which is incorporated in the current year or up to the due date of filing of return. It's all fine. So if I transfer the asset in 21-22, eligible company will means a company which is incorporated in 21-22 or till the due date of filing of return of this particular year. Secondly, this company should be a startup under 80 ISC. And this company in which you are investing, you should hold more than 25% of the equity shares in this company. Then this company will become what? Eligible company. Now, you have invested in the eligible company your money and the company has given you the shares. Okay. So now what the eligible company will do with that particular money? The eligible company will buy new assets with that money within 1 year from the date on which you have subscribed. So whatever date you have, what is the last date by which you can subscribe? I can subscribe till the last date of filing of return. So whatever date you will subscribe, the eligible company will buy new assets within 1 year from that particular date. So if the eligible company is not ready, if not possible to buy before the due date, then eligible company can deposit that money in what? In CGS scheme, and then they can withdraw within 1 year and purchase the asset. And if they do not withdraw within 1 year and purchase the asset, that will become deemed income of the eligible company. Okay, sorry, that will become deemed income of the assessee. Then comes what is new asset? New asset means nothing but new plant and machinery, but it will not include all those things which were covered in what? Which were covered in additional depreciation. Also, you can see the list is same as additional depreciation. But your computer software is also not allowed. But later on, the government said that if the startup is a technology-driven startup, then obviously computer and computer software should be allowed to the assessee to be bought. Then how much gain will be exempt in the hands of assessee? As I've told you here, if the assessee wishes to exempt the capital gains, he has to invest the net consideration and not the gain. So here the assessee has to invest the entire net consideration from transfer of long-term residential house property. If he invests the entire net consideration, then only it is exempt. Otherwise, it is not exempt. Then comes what is the effect if the amount is not utilized by from CGS within the time? If the amount is not utilized from CGS within 1 year, then it will become deemed income of the assessee. Assessee means whom? Assessee means the individual and HUF. It will become deemed income of the assessee. It is the duty of the company to buy within 1 year. If the company is not buying, the burden has to be borne by the assessee, that is individual HUF. Last but not least, there is a lock-in period on the shares. Shares is held by whom? Individual HUF. And there is a lock-in period on new asset. New asset is held by whom? The eligible company. So both the lock-in is 5 years. But there is one exception for new asset, that if the new asset is computer or computer software, the lock-in will be how much? The lock-in will be only 3 years. I hope everyone is clear with that. Apart from that, for shares, the lock-in is 5 years, and for all other assets, in case of eligible company, the lock-in is 5 years. Now let's go ahead with the next part of the capital gains, that is capital gains in case of block of asset. What will happen and how the capital gains will be computed in case of block of asset. So if you transfer the entire block, then you have to compare the consideration with the opening WDV and the purchases made during the work. So whatever opening WDV and purchases are made during the year, you will compare with what? Your net consideration. And if the net consideration is more, then there will be STCG. If the net consideration is less, then there will be STCL. So if you transfer the entire block, then there is no way that you will be escaped from capital gains. You have to pay capital gains, or there might be a short-term capital loss, as the case may be. But you have not transferred the entire block. You have only transferred a part of block. Then there will be two options. If your net consideration is less than opening WDV and purchase, and the block is not negative, it is still positive, because if your consideration is less and your opening WDV and purchase is more, then your block will be positive, and there are some assets in the block, then you will claim depreciation. This is an ideal situation to claim depreciation under PGBP. But if your consideration is more, say opening WDV and purchase is 10 lakh, and your consideration of few assets, not all assets, because you're not selling all assets over here. Your consideration for few assets is less than 10 lakh, then you will be, it is more than 10 lakh, sorry, then you will be liable for STCG. Okay. Now, few points to be kept in mind. Indexation benefit is not available in case of block of asset. Never, 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 never. Second, if your asset is a part of block and it gets destroyed and there is an insurance claim available on that, so that insurance claim, whenever received, will be reduced from the block of asset. Okay. Third. If you are negotiating with a buyer to sell your asset, sell your block of asset, to sell your furniture or sell your building to somebody which is a part of your block, and the other person forfeit, and you forfeit the other person's advance, then in that case, if advance was forfeited before 1/4/2014, listen carefully, great interlinking I am trying to do. I am trying to sell my block to you, but I have taken the advance also from you, but you are not paying the balance money, and this has happened all before 2014. So in that case, I will reduce that particular amount from the block of asset. Pay attention over here. The next one, which I have just said you in the previous topic, 54 EC talks about gain arising from long-term capital asset. It does not speak about that the gain should be short-term. It says that the asset should be long-term. So if the long-term asset is there, which is in the block, and you are transferring that land or building, especially building, and there is a long-term capital asset being building, and there is a short-term capital gain on that, because block always has STCG. So in that case, also you will be getting the benefit of what? Benefit of exemption. Next one is very important. What is the format of computing of capital gains? Or what is the format of taking what? Depreciation. Opening WDV of the asset, add purchases made during the year, less money payable. Now what is money? It is not sale, it is money payable which is reduced from the block. Now what is money payable? Money payable means on which there is a money which is receivable from your side, which is going to be received by you from somebody else. Somebody else is paying and you are receiving that money. That can be in the form of sale, that can be in the form of insurance, that can be in the form of salvage or compensation. So there has to be money payable in respect of an asset. Then only it is reduced from the block. So for example, I have purchased one asset which is a part of block, and I am not using that asset. I have kept aside that asset. That is asset is discarded. Now on that there is no money payable. So if there is no money payable, that amount cannot be reduced from the block of asset. You can see over here. I hope it is clear to all of you. And last but not least, you all know that from financial year 2021, goodwill is not allowed to be depreciated. So you have to reduce that much WDV from the block of asset. So earlier your intangible assets has two assets. Say you purchased some intangible assets of patent and goodwill in 2015. So you enjoyed depreciation on both on 15, 16, 16, 17, 17, 18, 18, 19, 19, 20. Till 1920, everything was allowed. Sorry, till 1920, everything was allowed. But from 2021, goodwill depreciation is not allowed. So you have to reduce that much WDV of the goodwill from the block of asset. So if you reduce that WDV from the block of asset, and if the reduction is more than the block, suppose the block value is 20 lakhs and the reduction is coming to 32 lakhs, then the differential amount will be considered as goodwill under the income tax law, as you can see over here. So you have to first of all compute both the things, get WDV as on 1/4/2020, and then compute the WDV of goodwill separately and remove from the block. And when you remove from the block, if there is a shortfall, then you will be liable for what? Capital gains under the income tax law. Okay. Now, these are the places where indexation are not available under the income tax law. First, this is the list, comprehensive list. In case of block of asset and in case of slum sale, indexation is not available. In case of debentures and bonds, indexation is not available, but sovereign gold bonds and capital index bonds, indexation is available. These are the two exceptions where we get the indexation. First provision to 48, indexation is not available. 112A, indexation is not available, as we have seen just some time before. And certain non-resident section, this is something which we will see in the chapter of what? Non-resident. Now let's go ahead with the next point, and that is taxation of demerger. For that, we need to first of all understand the definition of demerger. What is demerger? It is defined in section 219AA with subject to 6 conditions. You have to fulfill 6 conditions. First of all, what is written at the beginning over here, demerger means transfer of one undertaking of a company to another undertaking. The first undertaking will be called as demerged company. The second undertaking will be called as resulting company. And you have to fulfill 6 conditions. First condition, all the properties of the demerged company, the undertaking which is transferred will be called as, which is transferring is called as demerged company, and the undertaking to whom it is transferred, to whom it is transferred will be called as what? Will be called as resulting company. So whatever assets are transferred, all the properties has to be transferred from demerged company to resulting company. That is what is written in the first condition. Except few things which may not be transferred. One is miscellaneous expenditure, which can be also called as preliminary expenses or deferred revenue expense. All three things are one and the same thing. So all the properties of the demerged company has to be transferred to the resulting company. First condition. Second, all the liabilities also have to be transferred. Liabilities can be categorized into two parts. Specific liability of that department should be directly transferred, and general liability should be transferred in a ratio. What is the ratio? What is general liability? A liability which is applicable for the entire company, not specific to any particular unit. So general liability should be transferred in the ratio of whatever is the general liability multiplied by whatever assets are transferred. Whatever assets are transferred divided by whatever is the total assets of the demerged company. While computing assets, do not take two things. First, revaluation has to be excluded while computing assets. Second, the fictitious assets, preliminary expense, by whatever name called, whatever you want to say, that has to be assets, that has to be removed while computing the assets. Third, the properties and the liabilities have to be transferred at book value, and book value. However, if the other company is an Ind AS compliant company, then it might not be transferred at book value, it might be transferred at fair value. So in that case, for an Ind AS company, it can be transferred at fair value also, it is allowed. Okay. Next, the resulting company to whom the assets are transferred will issue shares to the shareholders of the demerged company, because the assets of the demerged company are getting transferred to the resulting company. So the resulting company will issue shares to the shareholders of the demerged company. The shareholders, at least 75% in value, just like amalgamation, has to be transferred from here to there. Then only it will be a valid demerger. And last but not least, it should be a going concern basis. It should be done on a going concern basis. If these 6 conditions are fulfilled, your demerger can be considered as a valid demerger under the income tax law. In the eyes of the income tax law, then it becomes a demerger. And then you can enjoy great benefits, which I'll be speaking about one by one right now. Okay. Now, there is one small amendment made by the government that if there is a reconstruction or splitting up of a public sector company into separate company, there is a PSU which is split up into 2 companies. One is demerged, one is resulting, then it is deemed to be demerger. Then you don't have to fulfill all these conditions. All these conditions need not be fulfilled for a public sector company. So this is an amendment made by Finance Act 2021. Now, this is an example which will help you to understand in a better way how exactly this provision runs around. I am coming to the tax implication. Obviously, I am not going to read the example over here. The first tax implication. Whatever capital assets are transferred by demerged company to resulting Indian company, the resulting company has to be an Indian company. So the assets which are transferred from the demerged company to resulting Indian company are exempt under income tax law. Secondly, later on, when the resulting company will sell those assets, the cost of acquisition in the hands of resulting company will be the cost of acquisition in the hands of the demerged company, and the period of holding will be clubbed. That is written in point number 3. Point number 2 talks about what? What will happen with the shareholders of the demerged company? The shareholders of the demerged company will relinquish their shares and will in return get 2 shares. So they will relinquish the shares of demerged company, and in return they will get 2 shares. First, they will get the shares of the resulting company, who the shareholders of the demerged company, and second, they will get the reduced shares. The paid up value of the existing company will be reduced, and they will be given a reduced shares. So now, in exchange of 1 share, they are getting 2 shares. They are giving 1 share and they are taking 2 shares. They are giving which share? The shares of the demerged company is given by them. They have relinquished their shares, and in return, they have taken the shares of resulting company, and they have also taken the shares of what? Reduced shares of demerged company. So in that process, that is also exempt under section 47. Now later on, what is there in the hands of the shareholder? The shareholders has 2 things. That is the resulting company shares and the demerged company's reduced shares. So when the shareholder will sell these shares later on, how will the cost of acquisition be determined in that case? In that case, there is 49(2)(c) and 49(2)(d). So first you have to compute the cost of acquisition of the resulting company. So remember, the company which came later, you have to compute the cost of that company first. Later, the better concept is applicable over here. Which company has come first? The company which has come first is demerged company. But don't compute the cost of acquisition of demerged company first. Compute the cost of acquisition of the resulting company first and then demerged company. So how will the cost of acquisition of the shares of the resulting company be determined? It will be same as the cost of acquisition of the demerged company shares multiplied by net book value of the asset transfer. When I say net book value, whatever assets minus whatever liability is transferred from demerged company to resulting company, that will be taken in the numerator, and denominator will be the net worth. What is net worth? Demerged companies paid up equity capital and only general reserve. That's it. Only 2 things will be added in net worth. Do not add other things in the net worth. For the purpose of this section, the net worth is restricted to only these 2 things. So what will be the cost of acquisition of the company which comes later? That is resulting company. It is the cost of acquisition of the demerged company. It is same as that. The price at which you have purchased the shares of demerged company, and multiply that with the net book value of the asset transfer and divide that by the net worth of the company. And then whatever answer will come, that will become the cost of acquisition of the company which has come later, not the former. The company which comes later will be computed first. And then what will be the cost of acquisition of the demerged company? It will be nothing but the original cost of the shares minus whatever answer you get in this particular 49(2)(c. That will become the cost of acquisition of what? Of the demerged company. I hope it is clear to all of you. This same calculation is also given in segregated portfolio. I'm just trying to do what? Do a kind of interlinking for you. Segregated portfolio is a new concept brought by Finance Act 2020. So that same concept is applicable over there also. What is applicable over here? I hope it is clear to all of you. Now let's go ahead and talk about taxation of cooperative banks. Here we are going to do amalgamation of cooperative banks. Okay. So when one cooperative bank is getting amalgamated with another cooperative bank, there are a lot of relaxation which the government has given. But Finance Act 2021 has made certain amendments. Now they have said that a cooperative bank can get merged with cooperative bank. You can enjoy relaxation. One more thing is added now. If a cooperative bank is converted or amalgamated with a normal bank, not with cooperative bank, then that is also eligible for exemption under the income tax law. So the first thing which we need to learn over here is what is 44DB, which talks about PGBP. And this talks about bifurcation of 4 expenditures. One is section 32, that is depreciation. 35D, which talks about preliminary expense. 35DD, which talks about VRS expense. And 35DD, which talks about amalgamation expense. And 35DDA, which talks about VRS expense. Now these 4 deductions in the year of amalgamation of a cooperative bank with a cooperative bank, and now of a cooperative bank with another bank which is not cooperative, normal bank, then in that case it will be bifurcated on the basis of number of days the company was existing. Suppose the amalgamating company got amalgamated with another company, another bank on 15th of December. So from 1st April till 14th December, that is 1 day prior to amalgamation, the expenditure will be allocated to the amalgamating cooperative bank, and after that, from the date of amalgamation, the expenditure will be allocated to the amalgamated cooperative bank, and now even to the amalgamated company. Okay, amalgamated bank. Now, this is different from what happens for amalgamation of companies. How it is different? Because in case of amalgamation of companies, which we have done earlier in the chapter of capital gains, obviously, there we have seen that in amalgamation of company, in the year of amalgamation, the entire expenditure goes to the amalgamated company. But here it is not like that. Here it is bifurcated between both of them. Okay. Second thing, what will happen with the losses of the amalgamating cooperative bank? Will that also be carried forward to the amalgamated cooperative bank? The answer is yes. The losses, that is only business loss mentioned in section 72, will be allowed to carry forward not for another 8 years, unlike the amalgamation of companies. Here you can carry forward the loss for only balanced number of years, and UAD you can carry forward for in unlimited number of years. But brought forward business loss will be carried forward by the cooperative bank, amalgamated cooperative bank, for the balanced number of years. Plus, here a respective amendment is not made. Means here a cooperative bank can transfer the loss to another cooperative bank, but a cooperative bank cannot transfer the loss to another normal bank. That amendment is not made in section 72AB. Be very careful. Then there are certain more provisions which we need to see. In case of amalgamation of a cooperative bank with another cooperative bank and now with a banking company, whatever assets will be transferred from here to there will be exempt under income tax law. Secondly, the shareholders of the cooperative bank, amalgamating cooperative bank, if they give back their shares and in return they take the shares in the new cooperative bank, that is amalgamated cooperative bank or a new bank, then that is also exempt in the hands of the shareholders. And this is the amendment which is mentioned over here, as you can see. And this is what it is written over here, that there is no corresponding amendment in 72AB. And because there is no corresponding amendment in 72AB, the losses of the amalgamating cooperative bank cannot be carried forward by the normal bank. Yes, it can be carried forward by the cooperative bank because it was there since earlier. But the amendment was not made with respect to a normal bank in the set off and carry forward chapter. I hope it is clear to all of you. Next, let us talk about taxation of ESOP. How ESOPs are taxed. Generally, what happens when an employee joins a company, the company offers him an ESOP and tells him that you have to work in our company for a few years and then we will allot ESOP. So when is ESOP taxable and how is ESOP taxable? These are two questions which we need to answer. The first question, how is ESOP taxable? So you have to take the FMV of the shares on the date on which the option was exercised by the employee. Suppose today I exercise the option that I want ESOP. So I will take today's FMV of the share and then I will reduce from that whatever amount I have paid to the company in the form of the cost of acquisition of the shares. So on the date of exercising the option, listen this date carefully. On the date of exercising the option, suppose the FMV is 100 rupees. So I have to take that as FMV. And how much I have paid to the company? So I have paid 30 rupees to the company. So 70 rupees will become taxable in my hands. So when it will be taxable? Now listen, when. It will be taxable not today when you have exercised the option. It will be taxable in the year in which the shares were allotted to you. So FMV will be taken of the date on which you exercise the option. But taxability will be done on the date on which the ESOP are allotted to you. The moment ESOP are allotted to you, it will be taxable in your hands. Okay. So exercise FMV of which date? Again, I'm saying on the date on which you are exercising. And taxability in which year? On the date in the year in which the ESOPs are allotted to you, it will be taxable. Okay. Now, there are certain benefits which are given to the employees of eligible startups. For employees of eligible startup, the taxability is deferred. It is deferred to which date? It is deferred to later of the 3 dates, and that too within 14 days from the later of the 3 dates. In case of ESOP employee, if I am an employer who is an eligible startup and you are an employee, and I give you, say for example, the ESOP today, it will not be taxable in your hands today. So it will be taxable when? It will be taxable within 14 days from the end of 48 months from the end of relevant AY. Suppose the previous year 21-22, I allotted the ESOP, it will not be taxable in case of eligible startup. In case of other than eligible startup, it will be taxable today only. But in case of eligible startup, it will be deferred to the later of the 3 dates. Earliest of the 3 days, not later. So 21-22, I am an eligible startup, you are my employee, and 21-22 is going on, and I allotted you startup. You compute the tax, etc. today only. And then within 48 months of the end of the relevant assessment year. So 21-22 is the previous year. Assessment year will be 22-23. So from that, within 4 years will come to 31st March 2027. And from that, add 14 days. So the answer is 14th of April 2027 for point number 1. What is point number 2? If I sell the shares before that, then that will be the last date. And if I leave the company before that, then that will be the last date. Whichever is earliest will be the last date in that year, which will be taxable. And if I do not sell the shares and if I do not leave the company, then 48 months from the end of the financial year and add 14 days. Add 14 days to all 3 of them, whichever is earlier. So tax will be computed as per which date? Today or in the year or in which I will be taxable. The tax will be computed as per 2021-22 rates only. As per 21-22 provisions only. Sir, when will the TDS deducted by the company? Company will deduct TDS in the future year when it will be actually received, when it will be actually taxable in your hands. Be very careful. For eligible startup, you will receive the ESOP today. You will compute the tax today as per today's date, but you will not pay the tax. You will not deduct the TDS today. You will deduct the TDS at the later of the 3 dates mentioned plus 14 days on that. Okay. So later on, I received the ESOP from the company. I paid the tax, whatever it is. 100 rupees ESOP, I receive for 70. So 70, I receive for 30 rupees. So 70 rupees is my perquisite. Later on, if I sell these shares, what will be the cost of acquisition in my hands? The cost of acquisition in your hands will be the FMV on the date of exercising the option. Don't worry about it. And your period of holding will also be clubbed. Your period of holding will also be clubbed. That it will be counted from the date of allotment of shares. Sorry. It will be counted from the date of allotment of shares when you receive the shares. So in case of eligible startup, it is deferred. What is deferred? Only the taxability is deferred. Tax will be computed as per 21-22 only when you are allotted the shares. TDS will be deducted later and you will pay the tax later. I hope it is clear to all of you. Next, taxation of buyback. If you buy back a share, I am a company, you are a shareholder. And I am buying back your shares and I am making you payment. So in that case, the government has said that 115QA is applicable for the SSE. 115QA. So what is applicable in case of 115QA? Whether it is a company which is a listed company or unlisted company, preference shares or equity shares, it doesn't matter. The treatment is same for everybody after 5th July 2019. So today is 21-22, the treatment is same for everyone. So if I am buying back your shares, then I'll be making the payment to you. So the company will pay tax under section 115QA at the rate of 23.296%. How 23.296% is arrived? It is written in the bracket. So company is liable to pay tax in this. So how much company will pay tax? 23.296. On what amount? Whatever amount company has paid to you minus whatever amount you have paid to the company to acquire the shares. Suppose you have paid 1 lakh rupees to acquire the shares and the company is making the payment of 9 lakh rupees to you. So the company will will pay tax on 8 lakh rupees. 9 lakh company has paid, you have paid 1 lakh, 8 lakh rupees into 23.296% tax company will pay. And then that amount will be exempt in the hands of the shareholder under section 1034A. Shareholders will not be liable for tax on that particular amount. I hope everyone is clear with this. With this note, your capital gains chapter is done now. So let's move ahead with the next topic, and that is taxation of dividend. The first thing which we need to learn over here is section 115 BBD. What is 115 BBD? It's a special rate section for certain companies. If I'm an Indian company and if I have a stake in a foreign company of 26% or more equity shares, and if that foreign company, now this foreign company in which Indian company holds 26% or more is called as a specified foreign company, and if that foreign company gives me a dividend, then that is taxable under this section at a special rate of just 15% instead of 30%, which is the normal rate for Indian companies. But in this case, there is one disadvantage to the assessee, that assessee will not get any deduction under the income tax law of any expense or any allowance. Okay. Further, assessee will also be liable for MAT on this particular dividend if it is credited to PNL, because in MAT, minimum alternate tax, there is no relaxation given for this particular dividend. Okay. Now, coming to the normal dividends which are generally received by shareholders. Generally, the dividend which is received by the shareholder is taxable under IFOS. And against that dividend, you get only one deduction. Nothing else would be allowed to you except one deduction which is allowed in section 57, and that is the interest expenditure. You will be allowed the deduction of interest expenditure, that too up to 20% of the dividend amount. So whatever is your dividend amount, you have to take 20% of that, and up to 20% it will be allowed subject to actual. If your actual is lower, then lower. If your actual is more, then you will be allowed deduction up to 20% of your total deduction, total dividends. Okay. Now, when the company will make the payment of dividend, will they deduct TDS? Yes. Indian company, domestic company, when they will make the payment to resident, they will deduct TDS under 194. And if they make the payment to non-resident, then they will deduct the TDS under section 195 and not here. Okay. Now, dividend TDS will be deducted on all kind of dividends, whether it is normal dividend, deemed dividend, equity dividend, preference dividend, all kind of dividend. But there are certain exceptions in which TDS is not deductible. First, if the shareholder is individual, and if you are making payment by other than cash, if you are making payment by cash, then you have to deduct TDS. So if the shareholder is individual, and if you are making the payment other than cash, and you are making the payment up to 5,000 rupees. So if the shareholder is individual, payment is made by other than cash, say maybe in check, RTGS, whatever it is, and if the payment is up to 5,000, then it is not supposed to be deductible. It means if the shareholder is individual and if the payment is made in cash, then you have to deduct TDS. And if the shareholder is individual and if the payment is more than 5,000, then also you are supposed to deduct TDS. Second person in whose case TDS is not applicable. When dividend is paid to LIC, GIC or any other insurance company, TDS is not deductible. Okay, no TDS is required to be deducted. Third, when dividend is paid to business trust by SPV, you might be knowing there is one topic which will come later on in the revision video, but you might have done in your respective classes, that dividends are paid by a SPV to a business trust, because business trust holds controlling interest in the SPV. So because business trust holds controlling interest in the SPV, SPV pays in the dividend to the business trust, and that is not subject to tax in the hands of business trust. And because that is not subject to tax in the hands of business trust, the dividend which is received from the SPV, it is not liable for TDS also. And last but not least, the central government may notify any other person in whose case this section might not be applicable. Now coming to the next one, which is very important for exam, very important for exam, which is ATM. ATM is applicable to which assessee? It is applicable to domestic company. Suppose I am a domestic company and I am receiving dividends from another domestic company or another foreign company and even from business trust. So I am domestic company, I am assessee, and I am receiving dividend from these three companies. Suppose I receive 100 rupees as dividend. Now, if I distribute that to my shareholders before 1 month from the due date of filing of return, so 21-22 I will receive dividend. Say I have received dividend of 100 rupees in 21-22. Now, if I distribute some amount out of that or entire amount out of that or more than that, whatever it is, if I distribute less than 100 or more than 100 or exactly 100, before my due date of filing of returns, 1 month prior to that, suppose my due date of filing of returns is 31st October, so 1 month prior to that, till 30th September 2022. So if I distribute that, even after the year ends, I can distribute. But before the due date of filing of returns, 1 month prior to that, then I will get a deduction under ATM. How much deduction? The dividend which I received compared with the dividend which I paid. Paid till which date? 1 month prior to the due date of filing of return. Dividend will be received in the financial year, but you can distribute even till the due date of filing of return 1 month prior to that. So whichever is less, amount received or amount paid 1 month prior to the due date of filing of return will be considered as what? As a deduction under chapter 6 under ATM to the domestic company, which is in point number 1. Okay. Now you have to actually distribute the dividend. Mere declaration of dividend is not sufficient. You have to distribute dividend, and once the deduction is taken, you cannot take that deduction in the next year again. Double deduction is not possible. Now, when can I say that dividend is my current year's income? In case of normal dividend, if the dividend is declared in the AGM, suppose if the dividend is declared on 17 June 2021, then it can be said that dividend is applicable, dividend is pertaining to the year of 2021-22. So in case of normal dividend, dividend is said to be of a particular year in which it is declared. So in this example, if the dividend is declared on 17 June 2021, then it is said to be that dividend is an income of 21-22, and I can distribute this income till which date? Till my due date of filing of return for 21-22, 1 month prior to that. Then in case of deemed dividend, when it is said that the dividend is your income, when it is distributed or paid to the shareholder. And in case of interim dividend, when it is said that it is the income of the assessee, it is said to be income of assessee in the year in which it is unconditionally made available to the shareholder. Unconditionally made available to the shareholder means it is when it is actually paid to the shareholder. That's it. Nothing great as such. So this tells you in which year you will show the income. This is given in section 8 of income tax law. That dividend is considered to be income of which year? When dividend is accrued in the hands of investor. This is what this particular section tells about. Okay. Now coming to, it's a very important section. Very, very, very important section. Now coming to deemed dividend. What is deemed dividend? There are 5 clauses in deemed dividend. 222A, 222B, C, D, E. Total 5 clauses. Okay. First 222A. In this section, you are distributing assets to the shareholders, not money. So it is deemed dividend in your hands to the extent the company possesses accumulated profits, whether capitalized or not. So if I give you assets worth rupees 10 lakhs, the value has to be measured in FMB. The FMB of the asset has to be considered for the purpose of calculating dividends. So if I give you assets worth rupees 10 lakh FMB, and if my accumulated profits in the balance sheet is just 6 lakhs, then dividend will also be 6 lakhs. It cannot be more than 6 lakhs rupees. It cannot be more than the accumulated profits, whether capitalized or not. In that also, if some profit you have capitalized in the form of, say, bonus shares, from reserves you have put in bonus shares, then remove that also, and that also should be forming part of accumulated profits. So if I have given you an assets worth rupees 10 lakh FMB, and in the balance sheet there is 6 lakhs of accumulated reserves, and there is 2 lakhs of bonus shares which has been capitalized from the reserve, that 2 lakhs should also be formed part of accumulated reserve. This is what this line means, whether capitalized or not. So you'll compare your 10 lakhs FMB with the 8 lakh rupees accumulated profits. Something which is capitalized, that also has to be considered, and something which is not capitalized, that also has to be considered. Okay. In subsection 2, in section 2 subsection 22 clause B, what has to be done over here? Here we are distributing to shareholders debentures, debenture stock, deposit certificate. Or we are distributing bonus shares to preference shareholders, not to equity shareholders. So if the company is giving debentures, debenture stock, deposit certificate, or bonus to preference shareholders, not to equity shareholders, bonus to equity shareholders does not amount to deemed dividend, then that is also deemed dividend in the hands of company to the extent the company possesses accumulated profits. Okay. Now let's talk about the third one, that is 222D now, and then we'll see 222C. This talks about if there is some reduction of capital, and by reducing the capital of the company, you are giving some assets to the shareholder. You are distributing something to shareholder by reduction of capital. Again, it will be amount to deemed dividend, and it will be taxable in the hands of the shareholder. To the extent, again, the company possesses accumulated profits, whether capitalized or not. So here there is a reduction of capital, and you are giving something to your shareholder by reducing your capital. Again, there will be the concept of deemed dividend. Okay. Next one is very, very, very important. Liquidation of companies. What will happen in case of liquidation of company in the hands of company and in the hands of the shareholder? We need to see the tax treatment in both the cases. Now, in hands of company, let us see. First of all, if the company sells the assets and then distribute money, then the company will be liable for capital gains because company is selling the assets. So, if the company sells the assets and then distribute the money to the shareholder, company will be liable for capital gain tax. Second option which is there with the company. Company is not distributing money, but company is not selling the assets. Company is distributing the assets itself to the shareholder. So, if the company is just not selling, not getting into the sale of all assets, and the company is directly giving assets to the shareholder, so listen carefully, then it is an exempt transfer under section 46(1). Company will not be liable for capital gains in that case. So, any transfer of assets by company to shareholders on liquidation is exempt under 46(1). But that will be considered as deemed dividend in the hands of shareholder to the extent the company possesses accumulated profits. Suppose there are 15 shareholders or there are 10 shareholders and the value of the asset in the balance sheet is 15 lakhs. Every shareholder will get asset of 1,50,000 rupees. And in the balance sheet, there is an accumulated profits of 5 lakh rupees. So again, I am saying, if there is an accumulated profits of 5 lakh and the assets are 15 lakhs, so every shareholder will get assets worth rupees 1,50,000. So company is giving the assets to the shareholder on liquidation. Company is not liable for capital gain tax, but shareholder will be subject to deemed dividend. How much? To the extent the company possesses accumulated profits. So the total deemed dividend in the hands of shareholder will be how much? Will it be 15 lakhs? No, it will be 5 lakhs. It cannot be more than the accumulated profits. So the shareholder will be liable for IFRS income under section 56 to the extent of 5 lakh rupees. 5 lakhs is the total dividend in the hands of 10 shareholders. So one shareholder will be liable for 50,000 rupees tax under IFRS as income from dividend. Now later on, the shareholders are also transferring the shares to the company on liquidation. So shareholders will also be liable for capital gains on relinquishing the shares in the favor of the company. So what will be the how the capital gains will be computed in that case? So you have to follow this particular structure which is given in section 46(2) in the hands of shareholder. This is the taxability of shareholders. That is the taxability of the transfer of shares by the shareholders in liquidation. So whatever amount is received by the shareholder from the company plus whatever is the FMV of the asset received by the shareholders of the company minus whatever they have assessed as deemed dividend under 225. In my example, 50,000 rupees. You have to reduce that much because that much is already taxable under IFRS. Reduce that much and that will become your net consideration. And after net consideration, you can reduce expenses, you can reduce your cost of acquisition and you will get long-term capital gains or short-term capital gains depending upon your period of holding. So I'm again repeating, this is a very important provision. There are direct questions on this of 8 to 10 marks in the exam. Please be very careful. See our question bank, there are questions on this particular thing in our question bank. So again, I'm saying when a company distributes assets to the shareholder, company is not liable to capital gains. Second, Shareholders are liable for deemed dividend to the extent the company possesses accumulated profits, and whatever deemed dividend shareholders are liable, that will be reduced from the full value of consideration. And what is the full value of consideration? The money received by the shareholder plus the assets received by the shareholder. That is the full value of the consideration for the shareholder. From that, you will remove deemed dividend to the extent they are chargeable under IFOs, and then a normal calculation. Okay. Now later on, if the shareholder transfer the asset, this asset, if it is transferred by the shareholder, what will be the cost of acquisition? The cost of acquisition of this will be the FMB on the date of distribution. That's it. Whatever FMB you have taken over here, you will take that as a cost of acquisition later on. I hope everyone is clear. Okay. Last but not least, when a shareholder is calculating capital gains, till when the period of holding has to be counted? The period of holding has to be counted till the date of liquidation and not till the date of what? Not till the date of distribution. Suppose the company is liquidated in June and the assets are distributed in August. So you have to compute period of holding till June only. I hope it is clear to everyone. Okay. So it's a very important section. Next one, the last one over here, 222E, loans and advances by closely held company. Now this section is only applicable to a closely held company, not to other companies. And in this section, closely held company, listen carefully. What is a closely held company? A closely held company is a company. Earlier also it has come. It has come in section 68. You can go and see over there. Unexplained cash credit. It has come in section 79. It has come once again. Later on, I have put a list where which all places closely held company is mentioned under the income tax law. I have given a complete list of that. I'll show you that in the next session. Don't worry about it. Or maybe in the next chapter in this session itself. So now I am a closely held company. This section is not applicable to all companies. Previous 4 sections were applicable to all kind of companies, but this section is only applicable to closely held companies. I am a closely held company and you are my shareholder. What kind of shareholder you are? You hold 10% equity shares in my company. So if a shareholder holds 10% or more equity shares in a company and the company gives loan to that shareholder, it is deemed dividend in the hands of the shareholder. At the same time, if there is one concern means there is a firm, there is an HUF, there is a company in which you means you are a shareholder. Which shareholder? In which that shareholder who has 10% shares in me. And if there is one concern in which you have 20% substantial interest, 20% stake in that entity, and if I give loan to that entity, then that is also deemed dividend in the hands of that entity. So these 2 areas are covered over here. I give a loan to a shareholder who holds 10% or more, or I give a loan to a concern in which such shareholder has 20% or more. In both the cases, it is deemed dividend in the hands of the respective person. You are liable to pay tax. Again, to the extent the company possesses accumulated profits. But here, only to the extent company possesses accumulated profits, whether capitalized or not, this term is not used over here. Be very careful. In the previous 4 section, it was used as whether capitalized or not. But here, it is whether capitalized or not, it is not used. It is not mentioned over here. Okay. Is the company liable to deduct TDS also? Yes, the company is liable to deduct TDS under section 194. It is liable for deduct TDS. Then, here also, the company has to consider dividend only to the extent the company possesses accumulated profits. Yes, it cannot be more than that. What if the shareholder repays that? It doesn't matter. Whether the shareholder repays or doesn't repay, it doesn't matter. Even if the shareholder repays that particular loan, it will be subject to deemed dividend in the hands of the shareholder. I hope it is clear to all of you. Okay. Okay. But yeah, here there are some issues which are given. First, the trade advances which are in the nature of commercial transaction would not fall within the ambit of what advance. So if I am giving a trade advance, shareholder is my creditor also. So I am giving a trade advance to the shareholder. Can it happen that my shareholder is my creditor? Because I purchased raw material from my shareholder. So I am giving a trade advance to him. That will not amount to deemed dividend, something which is mentioned over here. This is a very important aspect. Okay. Now, there are certain things which will not come in the definition of dividend. Listen carefully. First point. First point which will not come in the definition of dividend is as follows. Pay attention, please, all of you. First point. I am a company, you are a shareholder. And I gave you a loan. You are a 10% shareholder. So I gave you a loan. Is that a deemed dividend in your hand? Yes, it is. So you'll be liable for tax on that particular amount. Now, after a few months, I am giving you actual dividend, not deemed dividend. And you are saying that don't pay me actual dividend, set off this dividend against my loan because you have to anyways pay me the loan. Listen carefully. I gave you a loan of 1 lakh rupees and that will be chargeable as deemed dividend in your hand because you are 10% shareholder. Now, after a few months, what happened that I am giving you actual dividend. So you are saying don't pay me the dividend, knock off this against loan and reduce the outstanding. So if I do that, then that particular amount is not dividend in your hand. Please pay attention over here and you can see this example over here. So any dividend paid is knocked off. If I pay you dividend subsequently and that is knocked off against deemed dividend under 222E, then that dividend which I am paying you will not be dividend in your hands. It will not be subject to tax. You will get relaxation over here. Second, if a company, closely held company, gives advances or loans to the shareholder and giving loans and advances to the shareholders forms substantial part of the company and it is in the ordinary course of business, I am giving you at normal rate. The way I am giving to others, I am giving you also at that same rate. And giving loan is my ordinary course of business. And giving loan and earning money out of it is my substantial amount of income, then 222E is not applicable. You can check over here. Okay. Now let's go ahead with the next topic, and that is again a very important topic, small topic but an important one, that is taxation of gift, which is covered in section 56 to 10. Okay. So this provision is applicable to any person who receives gift. What kind of gift? On or after 1st April 2017 from any person or persons. What kind of gift? First, money. If you receive money in excess of 50,000 rupees in the entire year from one person or more than one person, it doesn't matter. In total, it has to be exceeding 50,000 rupees. So if I am receiving some money of 30,000 rupees from Mr. A and 30,000 rupees from Mr. B in the same financial year, I am liable for gift tax under section 56 to 10. Okay. Second, if I receive some immovable property, then in immovable property, there are two ways in which you can receive immovable property and it will be liable as IFOS income. First, you are receiving it absolutely free without any consideration. If you are receiving an immovable property, that is land or building, without any consideration, and if the stamp duty of that particular property is greater than 50,000 rupees, then it will be IFOS. Okay. Second, you are receiving with the consideration. It means you are paying some consideration for it, but the consideration is not sufficient. It is an inadequate. Then in that case, if your consideration and the stamp duty value difference is greater than 50,000 rupees, then it is liable to be taxed in your hands. Okay. So if I purchase a property for say 10 lakh rupees and the stamp duty value of that property is say 12 lakh rupees, so the differential amount is more than 50,000 rupees. And so in that case, if the differential amount between the actual consideration and the stamp duty value is greater than 50,000 rupees, then the differential amount will be IFOS in my hands. But for immovable property, there is one more condition which we need to see over here. We need to also see to tax it as IFOS income, there has to be a difference of more than 110% also. So along with difference of 50,000, there has to be a difference of 110% also. For example, if I purchase a property from you, okay, say for 10 lakhs, and if the stamp duty value of that property is 12 lakhs, so the differential amount, is it more than 50,000? The answer is yes. One more condition has to be fulfilled. The differential amount, is it more than 110%? The answer is yes. Because my actual consideration for the property is 1 lakh and I am paying 12 lakhs to you, 10 lakhs and I am paying 12 lakhs to you. So the difference between the two is 120%. Okay. So the difference has to be more than 120%. The difference has to be more than 50 lakhs. So I'll give you another example. Say 1 crore is the property, is the price at which I bought the property. Now, suppose the stamp duty value is 1 crore 5 lakhs. So stamp duty value 1 crore 5 lakhs. I purchased the property at 1 lakh. 1 crore. So the differential amount is more than 50,000. The answer is yes. The differential amount is 5 lakhs. But this is not sufficient for immovable property. You also have to check is the differential percentage is more than 110%. The answer is no. Because 1 crore and 1 crore 5 lakhs will have exactly 105% difference. Therefore, it is not going to be IFOS income. The moral of the story I am trying to say, in the hands of the recipient of the immovable property, you have to check two conditions, 110% and also 50,000. But here also there are twists, which has been made by Finance Act 2021. In some cases, this 110% will also become further higher at 120%. In some cases, it is 120%. That is, what is that case? That is, if you are purchasing a residential house between 12th November 2020 to 30th June 2021. So this date has to be kept in exam. They will deliberately ask you a question based on this date in the exam. So please keep this date in your mind. Okay. So if you are purchasing a residential house property, not a commercial property, not a land, residential unit between this period, 12th November 2020 to 30th June 2021, and this is your first allotment, this is your first house of your life, and the consideration is up to 2 crore rupees. It is not exceeding 2 crore rupees. So if you are purchasing a house, your first house, and it is your first house and the consideration is up to 2 crore rupees, then in that case, you have to check 50,000 along with 120% and not 110%. I hope it is clear to all of you. Okay. Coming back to the discussion, the third thing which if you receive, it will be liable for tax as gift tax. First was money, second was immovable property. In immovable property, you have to check two conditions, 50,000, 110%. In some cases, 50,000 and 120% as amendment made by Finance Act 2021. Okay. Now, the third thing is movable properties. This is movable property. What is covered in this? There is an exhaustive list. Apart from this, nothing else will be covered over here. Shares and securities, yes. Jewelry, yes. Archaeological collection, yes. Drawing, yes. Painting, yes. Sculptures, yes. Any other work of art and bullion. That's it. Nothing else apart from this will be liable for gift tax. Once the list is completed over here, it is a comprehensive list. Sir, if somebody gives me cryptocurrency, whether that will be liable for tax? No. If somebody gives you a crypto for gift, it is not liable to tax because crypto is not mentioned over here. Somebody is giving you Bitcoin as gift, it is not liable to tax because Bitcoin is not mentioned over here. Be very careful. Only this exhaustive list of movable property is covered. Nothing else apart from this. Somebody gives you a BMW in gift, it is not liable to tax because BMW is not mentioned over here. Car. So how it has to be seen? Again, if it is absolutely free, then the fair market value has to exceed 50,000. If you are purchasing for less consideration, inadequate consideration, then the differential amount has to exceed 50,000. So the jewelry's market value is 12 lakh. You are purchasing at 10 lakhs. So the differential amount of 2 lakhs will be IFOS in my hands. Okay. And only one condition. There is nothing like two conditions over here. Okay. I hope it is clear to all of you. Let me go ahead now. There are some exceptions in which this section is not applicable. First exception is when a holding company gives asset to 100% subsidiary or a 100% subsidiary gives asset to a holding company, then it is not liable to give. So if I am a subsidiary, I am receiving some asset from my 100% holding, or if I am a holding, I am receiving some asset from my 100% subsidiary, it is not liable for tax. Okay. Once the tax is paid by the recipient, when later on the recipient will sell the property or assets or immovable property, what will be the cost of acquisition? Suppose if I buy a asset, say of rupees, say for example 1 crore, but the stamp duty value of that property is 1.5 crore. So 50 lakhs I have to pay tax. I suppose yes, I paid tax on 50 lakhs. So later on, whenever I will sell that property, my cost of acquisition will be 1.5 crore. Otherwise, there will be double taxation. I purchased the property for 1 crore, but the stamp duty value was 1.5 crore. So the differential amount is more than 50,000 and the differential amount is more than 110% also. So in that case, 50 lakhs is IFOs. Later on, when I will sell the asset, I will be liable for what? I will be liable for capital gains of sale consideration minus 1.5 CR as cost of acquisition. This is what is given over here. Okay. In some cases, this section is not applicable. This section is not applicable if the gift is received from relatives. Now, what do I mean by the term relatives? Relatives is defined over here in a very exhaustive manner in case of individual who are relatives. This is a very different definition. There are two relative definitions. One is given in 241, which is a very small definition. But this definition is different from what is given in 241. 241 is a different definition. This is a different definition. This one is very exhaustive as compared to what is written in 241. What is relative? Let me explain it from my perspective. All of you can understand from your respective perspective. Spouse of an individual, my wife is my relative. Brother and sister of an individual, my brother and sister are my relatives. If I receive assets from them, it is not taxable under IFOS. Brother and sister of spouse of the individual, my wife's brother and sister are also my relative. Brother and sister of the either of the parents of the individual, my parents' brother and sister, my parents, my mom's brother and sister, my dad's brothers and sisters are also my relatives. Lineal ascendant, lineal descendant of mine. Lineal ascendant means what? Lineal ascendant and descendant means descendant who is above me. Like my parents, my grandparents are my descendant. My child, my grandchild are my ascendant. Lineal ascendant, descendant of my spouse parents, my spouse children are also my relatives. Spouse of all these persons and whomsoever we have mentioned from point number 2, 3, 4, 5, 6, everybody's respective spouse will also be considered to be my relative. In case of HUF, any member is considered to be a relative. So this is a very exhaustive definition as compared to what is written under the income tax law under section 2, clause 41 in the section 2 definition. Now, if you receive any gift on the occasion of marriage, not subject to tax. By will or inheritance, not subject to tax. In contemplation of the death of the payer, what do I mean by this? Suppose there is some dangerous disease to me. So the doctor has said that you're not going to live for very much time. So I'm giving my wealth to someone. So in that case, if I give my wealth to someone, that is not subject to tax. If I receive from local authority, if I receive from certain trusts, institutions, etc., it is not subject to tax. All these things are same only. If you are received from certain trusts and registered under different clauses. And if you receive by way of transactions which are not regarded as transfer under section 47. Like as I've told you, in case of holding subsidiary, in case of amalgamation, if you receive, in case of demerger, if you receive anything, then it is not subject to tax. All those things are mentioned in different clauses of section 47. If you receive from an individual by a trust created solely for the benefit of the relative of the individual, not subject to tax. And last but not least, 11th point, such class of person and subject to such condition as may be prescribed. Whenever the word prescribed will come, understand that there will always be a rule on this. So any other class of person and subject to such condition as the government may prescribe. Has the government prescribed? Yes, government has prescribed rule 11 USC. And in this case, government has prescribed 3 categories of person. Category 1, category 2 and category 3. These assessees will not be liable for gift tax. First, if a category 1 is receiving immovable property is received by whom? A resident of unauthorized colony of Delhi. You might be knowing in Delhi, the government has promised that all those who have unauthorized colony, we will authorize them and we will give them fresh colonies. We will give them authorized colony. So if you are a resident of Delhi and you have unauthorized, you stay in unauthorized colony. And if the government has given you houses in the authorized colony, it will not be liable for tax under the income tax law. This is what is given over here. Second, this is same as section 79, which I have told you in section 79 long back. Here you are receiving, here the shareholder is the recipient and the shareholder is receiving unquoted shares. Unquoted shares of a company and its subsidiary and subsidiary of such company, which is that particular case, which is same as section 79. As you might be knowing that the tribunal, the central government has the power that they can move a petition to National Company Law Tribunal, and National Company Law Tribunal can dismiss all the board of directors and remove the shareholders and bring new shareholders. In that case, if you are getting some shares in the new company, that will also be not subject to IFOS. And third one is to revive Yes Bank. We all know that Yes Bank was subject to close down, but somehow the government has revived that. So in the case, if the investor or investor bank is receiving some equity shares of reconstructed Yes Bank was reconstructed in 2020. So if the investor is receiving some reconstructed shares of Yes Bank, then that will also not be liable to tax. I don't know whether you have done all these things in your respective classes or not, but these are the things which are there in your syllabus. You open your study material. And therefore, I say that this book, very concise book, this is the super compact book. It is not compact, it is super compact. But it covers almost everything which is relevant for your exams. Everything in a very concise manner. Anyways, this one is very important provision. If there is a resident in India, and if that resident gives money to a non-resident outside India, I am a resident, you are non-resident, and if I give you money outside India, then it will be taxable in the hands of the non-resident it will be deemed to accrue rise in the hands of non-resident under the income tax law. So the giver is resident, the receiver is non-resident, and it is received outside India, it is taxable in the hands of the non-resident. Okay. I hope it is clear to all of you. Now, this is the definition of gift in contemplation of death. As I have told you, what is gift in contemplation of death? Suppose there is some disease to me and I am going to die. So, I am giving my wealth to you. In that case, I am contemplating a death and I am giving you a property. In that case, it is exempt in your hands. Okay. Last but not least over here. Gift tax is applicable in the hands of recipient only if the gift is received in the form of capital asset. If the gift is received in the capacity of stock in trade, gift tax is not applicable. In short, gift tax is not applicable to traders of the gift. Suppose if I am a trader of jewelry and if I receive jewelry, then it is not applicable in my case. If I am an investor of jewelry and if I receive invest as gift as an investor, then it is taxable under IFRS. For trader, it is not taxable. You have to receive the property in the form of what? A capital asset, not in the form of what? Stock in trade. I hope it is clear to all of you. 43CA. What is 43CA? It is exactly a copy paste of 50C. What is 50C? 50C talks about when you transfer land or building or both like a capital asset. Then your sale consideration will be actual consideration or stamp duty value, whichever is higher. In that, you have to consider the stamp duty value should exceed 110% of your sale consideration. Do you remember that? Then whichever is higher. If you are not satisfied with that, then you have to go to what? Assessing officer. Assessing officer will send you to department valuation officer. Then department valuation officer can reduce the value, increase the value. Everything is same over here. But just one difference, and the difference is in 50C you transfer capital asset and in 43C you transfer stock in trade. If that immovable property or land or building is your stock in trade, then 43CA is applicable. Rest everything is same. And even this amendment which was made in 56(2)(10), that is made over here. Exact same amendment. That is for seller also. For buyer also it was there 120% and for seller also it is 120% as you can see over here. Can you see this? Same. If the seller is selling the residential unit between this period and it is first time selling and the consideration is up to 2 crore, the seller will also get an advantage of 220% benefit. I hope it is clear to all of you. Okay. Then these two provisions are also same as 50C. I am not repeating also. Last but not least, for a closely held company, where a closely held company receives from resident, I am a closely held company, you are my resident shareholder and I am issuing you shares and you are giving me money, and if you are giving me money more than the FMV of the shares, then the difference between the FMV is 30 rupees, but you are paying me 200 rupees. You are paying me more than the FMV, then 170 rupees differential amount will be taxable as income of other source of the shareholder of the company. So the company has to issue shares at fair market value, not more than that. If the company is issuing shares at more than fair market value, then the differential amount will be taxable in the hands of the company. As you can see, this section is applicable only if the shareholders are resident, not non-resident. I have explained you in detail in class the logic and the modus operandi, how the assessee is used to save tax and evade tax in this particular case, and that is the reason Finance Act 2012 brought this concept of angel taxation. This concept 56(2)(7)(b) is also called as angel taxation. Now 56(2)(7)(b) is not applicable in certain cases where it is received, where the consideration is received by a venture capital undertaking. Where a consideration is received by venture capital undertaking means venture capital undertaking is issuing shares from a venture capital fund or a venture capital company or a specified fund. So the company is this and these are the shareholders. If that is the case, then this section is not applicable. It is not applicable by a company from class or class of person as may be notified, and who is notified over here? Startup companies are notified over here. If it is issued to a if it is a startup company and they issue the shares, for them 56(2)(7)(b) is not applicable. Third, it is not applicable to a non-resident shareholder, as I have already told you. It is only applicable to resident shareholder. And fourth, it is not applicable to a widely held company. As you can see, it is only applicable to a closely held and closely held and closely held company. That's it. Last but not least, there are certain conditions to be fulfilled in point number 2. If you do not comply with those conditions, you will be liable for IFRS income, and along with that, you will be liable for penalty of 200% because this case is considered as misreporting income and not underreporting income. There are certain conditions which are notified by central government over here in point number 2. If you do not fulfill that condition, you will be liable for IFRS first of all. You will not be exempted. You will be liable for IFRS and you will be liable for 200% penalty also on that particular income. Okay. Now, these are the cases which I have listed down for you all where closely held company is mentioned under the income tax law. You can go through it once. Now, let's go ahead with the next one. That is the deduction for SEZ unit. You have to do what? You have to open a unit in SEZ and then you have to manufacture goods and export out of India. Or you have to export computer software. So whatever you will export out of India in the form of goods or in the form of computer software, you will be liable for great deductions over here. First 5 years, 100% of the profits and gains derived from exports are subject to deduction. Next 5 years, 50% of the profits are subject to deduction. And after that next 5 years, that is 11th year to 15th year, you will be eligible for another 50% of the profits provided you transfer that profit to SEZ reinvestment allowance reserve. Now you have to transfer the profit. In the first 10 years, you don't have to transfer any profit to SEZ reinvestment allowance reserve. But in 11th to 15th year, if you want the deduction, you have to transfer the profits to SEZ reinvestment allowance reserve. And you have to use as per subsection 2. How am I supposed to use? Suppose I transferred whatever the amount. I have to withdraw that amount and I have to purchase a new plant and machinery and use before expiry of 3 years from the end of the year in which the reserve was created. Suppose the reserve was created in 21-22. So I have to withdraw that particular money later on. First of all, in 21-22, I have to create the reserve. Once I created the reserve, then in 31st March 2025, I have to use that reserve as by purchasing the plant and machinery and then put to use. Till then, I am supposed to keep that reserve intact. Later on, I am supposed to put the particulars in the IOI, that ROI, return of income, that I have purchased the relevant machinery within the time, etc. This is a formality. Now, next, if I am not able to utilize the reserve, okay, or if I am wrongly utilizing the reserve. If I am wrongly utilizing the reserve, so it will become deemed income of the year in which is wrongly utilized. Wrongly utilized means what? I withdrawn the money and I purchased the second plant and machinery. Then it is wrongly utilized. It will be deemed income. And if I am not able to utilize the reserve till 3 years, then it will become deemed income of the 4th year, not of the 3rd year. It will become deemed income of 4th year. Suppose 21-22 is the year of reserve. So 3 years complete on 31st March 2022, 31st March 2025, sorry. And then if you do not utilize till 31st March 2025, it will become deemed income of 31st March 2026. Okay. Now, how much deduction will be available to me? Deduction is available as follows. Pay attention over here. That is whatever is the profits of that undertaking, multiply by export turnover, divided by total turnover. Now, we need to understand one by one that what do you mean by the term export turnover? Export turnover is defined over here. Let me tell you one by one all of it. Export turnover means a turnover which is received in India within 6 months in convertible foreign exchange. The turnover has to be received in India within 6 months from the end of the financial year. So for 21-22, the turnover should be received in India. The consideration should be received in India till 30th September 2022. Plus, it does not include insurance, freight, and other charges. It means the turnover has to be a FOB price. It should not be a CIF price. It should be an FOB price. Third, turnover will not include certain PGBP allowances like profit on sale of license, import benefits, cash compensatory support, all these things, duty drawback, all these things will not be part of export turnover. Okay, so export turnover includes what? Money which is received within 6 months. Again, then an FOB price does not include insurance freight, and then again it does not include certain PGBP benefits which are covered in section 28. If you remember the special charging section of PGBP, that is cash compensatory support, duty drawback, or you can say import license, profit on sale of import. All those things will not be covered. Now, what will be the denominator? The denominator will be total turnover. What will be the total turnover? Total turnover again will be an FOB price. It will not be a CIF price. Again, it shall not include. It is same as this point. Okay. Further, total income will not include these things, which is mentioned over here. Point number C. Total turnover will also not include profit on sale of license, duty drawback, cash compensatory support. But in total turnover, you will include the entire turnover. Even that turnover which is not received in foreign exchange. It doesn't matter now whether the turnover is received in foreign exchange or whether it is not received. It doesn't matter whether the turnover is received within 6 months or received beyond 6 months. Total means total. Take everything in that. Okay. Now you will multiply this proportion with profits of the undertaking. How to determine the profits of the undertaking? It is like a normal PGBP income. Normal PGBP income. Add everything from section 28 to 43. Add less. Section 28 to 43. Whatever you do that. But remove few things from that. That is, whenever you will add from 28 to 43, you will remove few things now. First of all, you will remove profit on sale of import license. Again, this is something which is getting removed from all three items. Profits on sale of import license has to be removed. Duty drawback has to be removed. Cash compensatory support has to be removed from the profits. And then whatever the amount will come, that will deduction you will get. Okay. Now, there is one circular over here of the CBDT which came in 2013 speaking about certain benefits to the assessee. Because the circulars are generally issued for the benefits of the assessee. This circular is also for the benefits of the assessee. Now, what are the benefits over here? Suppose the assessee makes the software by going to client's place, then will that also be considered as an export? The answer is yes. It should be written in the contract that the client has given contract to the SEZ unit. If the client has given contract to the SEZ unit, and if the if the assessee goes to the client's place and develops software there, it will be benefited. It will be allowed. The benefits will be allowed to the assessee of 10AA. Second, suppose if I do not make a software, but I deploy employees for the purpose of making software. Software is made by somebody else, but I am deploying employees for making software. Will I still get the benefit? The answer is yes. Suppose there is a change of ownership in my business. I am doing my business, I am doing export, etc. Now I am getting amalgamated with another entity. So will the benefit be passed on to the another entity? The answer is yes for the balance number of years. So if I transfer my undertaking as a slum sale to someone, or if there is an amalgamation, if there is a demerger, will the benefit be allowed to the successor? Yes, it will be allowed for the balance number of years. Or if I change my location of SEZ from one state to another state. So if I move from Mumbai SEZ to Bangalore SEZ, will I get the benefit? Or Mumbai SEZ to Tamil Nadu SEZ or Kerala SEZ? Will I be getting the benefit of that? The answer is yes. You will get the benefit of that for the balance number of years. Don't worry about it. Okay. Now, if I convert an EPZ, that is export profit zone, or FTZ into SEZ, then what will be the tax implication? In this case, you have to think like this. Suppose first of all, you are an FTZ or EPZ and your 3 years have gone. Now, after 3 years, you are going to convert into SEZ. then you will get the benefit for the balance 7 years. You will get the benefit for balance 7 years. You will not get for another 10 years. Suppose if your 10 years is already expired, then you will not get any benefit under income tax law. Okay. Now, one last thing is this section was supposed to be ended on 31st March 2020. 31st March 2020 was the last date by which you should have commenced the operations in SEZ. Anybody who has commenced the operation till 31st March 2020 will get the benefit. After that, if you have commenced, you will not get the benefit. But you all know that what happened in March 20. March 20, there was COVID. And there were a lot of people who were not able to start their business because of COVID. Because from 22nd or 23rd of March, there was a complete lockdown in the country. So the government issued a press release and said that all those who have taken an approval earlier till 31st March, can open their unit till 31st March 2021. Provided approval should have been taken till 31st March 2020. If you have taken approval till 31st March 2020, you get an extension till 31st March 2021. You can check it over here. Now let's move on to the next topic, that is taxation of mutual fund and its unit holders. If you receive any dividend from a mutual fund or UTI, if you receive any dividend from mutual fund or UTI, it is taxable under IFOS. Now UTI is segregated by the government into two parts. One part of UTI is given to certain specified company and one part of UTI is managed by certain administrators of UTI. So specified company is outsourced and administrator are in-house. You can say something like this. The detailed story I have said you in my regular batch, exactly how it has been broken and why it has been broken. Because generally when we do any provision in class, we learn the logic of the provision first, when it came, what circumstance it came, and then we try to understand the provision and its tax implication. This is how we do the entire subject in our syllabus. That is the reason we require time to understand the subject. So when you receive dividend from mutual fund or UTI, it is taxable under IFOS. UTI is segregated into two parts, specified company or administrator. Now, will the investor, that is the unit holder, get any deduction? Yes, investor will get deduction only one, that is interest deduction, that to up to 20% of the gross dividend, which I have already told in taxation of dividend income. In case of dividend of shares also, and in case of dividend of mutual funds and UTI also, in case of both the dividends, you will get only one deduction under section 57, and that is interest deduction, that to up to only 20% of your gross dividend, not more than that. Okay. Now, TDS implication. When the company will pay you the dividend, will they deduct TDS? Yes. When they make the payment to resident shareholder, they will deduct TDS at the rate of 10% on payment or credit, whichever is earlier. In some cases, they are not liable to deduct TDS. First, when the threshold does not exceed of 5,000 rupees, up to 5,000 rupees, if they are making a payment, TDS is not deductible. And if they are making the payment in the nature of capital gains, they will not deduct TDS. It means if you are selling the units and they are making the payment, then that income is in the nature of capital gains. It is not in the nature of dividends, right? So that income, if you redeem the units and if you take the money, then that is not liable to TDS. Okay. In case the share unit holder is non-resident, then will they deduct TDS? The answer is yes. They will deduct TDS at the rates in source, and that is the rates in force is how much? That is 20% over here under section 196A. The TDS section is 196A for non-resident, and for resident it is 194K. For resident investor, it is 194K, and for non-resident investor, it is 196A. Now, what is the timing? Timing is same as both the places. Here also, it is payment or credit, whichever is earlier. Here also, it is payment and credit, which is earlier. Now, here also, there is some exception. If the investor is NRI or if the investor is non-resident HUF and the investor has purchased the units from what? From the NRE account, has purchased the units from the NRE account or any other account from where the funds are remitted in foreign currency, then in that case, TDS should not be deducted. So if the company is making payment to NRI or non-resident HUF who has purchased the units from NRE account, non-resident external account, then TDS will not be deducted. Is it clear to all of you? So I'm just stopping this session over here. I hope you all have enjoyed the session to a great extent. I am giving my best so that maximum things are covered in this revision videos, even though you guys have not learned direct tax from me, because unfortunately till last attempt I was not taking an English batch, but now I take full English batch. My batch has already started for May 23 and November 23. A full English batch of approximately 220 to 230 hours, whereby each and every provision of the ICI material will be taught in great detail, with great expertise, with great application, whereby the logics of each and every provision will be told to the student, whereby the application of in the exam, how it has to be done, what are the various angles of a particular section in which ICI can think about, and what ICI cannot think about. That is also something which we will be doing in class, along with the past RTPs in the class, along with the past mock test papers which we will be solving in the class itself, along with the discussion of past papers which will be doing in the class itself, along with all the FA 22, Finance Act 22 amendments which will be doing in the class itself, with the practical questions on the amendments, along with all the ICI material questions which will be solving in the class. More than 300 practical questions we will be solving in the class, and great practical questions, not very simple one, extreme questions which will make you an expert of the subject. And believe me, if you are done DT with me in my regular batch, exemption is just a cakewalk. You can aim for all India highest. Exemption will not be a concern only after that. So if any of your friends are interested in that, please tell them to contact on this number which is mentioned over here. And they tell them to have a faith on me. Once they have a faith on me, their approach towards the direct tax will be absolutely overturned as compared to what they have been doing since last so many years. And in case somebody who is not able to clear their exams of direct tax because of the lack of knowledge, because of the lack of application, because of the lack of preparation, you can tell them also that learn like this, then you will be able to understand how it has to be approached in the exam. And at the same time, we also keep a test series free of cost for all our students. Even for November 22, if you want, you can take my test series paper from my website, aarishkhan.com, free resources. Or you can WhatsApp me on this number. I will send you the test series paper. For you guys, test series was started on 16th of August. The first paper was on 16th of August. Second paper is on 1st of September. Third is on 16th of September. And fourth is on 5th of October. This is how the things will be done. Okay. So that's it from my side as of now. Thank you very much. God bless you all. Take care. I hope you all will do great in your exams. Bye all of you.